the Fed's more than likely to go through neutral, to go from a restrictive stance on policy to a stimulative one in the coming year.
With the Fed, a big piece of the caution is they are, to their core, data-driven in their monetary policy. And we know data are messy.
The market looks very convinced that a cut is coming.
Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
Starting in the first half of next year, you could see the Fed not explicitly but implicitly start to signal pauses.
This is Bloomberg Surveillance with Jonathan Berro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance with equity futures on the S&P 500 up by 0.2%, just a little bit of stability. Check out the Nasdaq 100. Your scores look like this, up 0.33%. And check out the bond market. Speaking of stability, a big sell-off at the long end of the yield curve in last week's sessions. The 10-year up by more than 20 basis points. Similar move on a 30. We're down about 1 basis point on a 10-year this morning, 438.29. Your week ahead is stacked, full of data. The data point of the week is U.S. retail sales. The central bank decision of the week is the obvious one. The last full week of trading for 2024, the last Fed decision of the year.
And widely expected to be 25 basis points. Welcome back. It's good to see you.
It's good to be back,
We
Ramo.
miss you.
You know what it's like, a week away, you struggle with speaking, working out when the show starts, when it finishes, what to say next. It takes a while just to get in the groove.
It started. We've got 3 more hours. I'm sure you'll be fine. I'm honestly really interested to see how the Fed signals into 2025 at a time where everyone is flying blind, including drones. But there's a question here about how much they can signal and how much they're going to take into account some of the potential policies coming from the new White House.
Exactly. When it comes to basically what are they going to say in terms of what the market is pricing in, which is a Trump trade, and how divergent we've seen the Fed be from financial markets. Bill Dudley spoke to us last week, and he talked about how in November, Powell's response was categorical. We don't guess, we don't speculate, we don't assume. And he says this time around, Jay Powell should be more nuanced.
I agree with you both. Federal Reserve is interesting for those reasons. I think there are far more interesting things going on right now that we should be talking about. Terry Haines of Pangaea is going to join us a little bit later this hour. US telecom networks hacked. Unexplained mysterious drones flying over New Jersey and much of the East Coast. That's 2. 3, the sabotage of telecoms cables in the Baltic. And you put it all together, the backdrop right now, the highest geopolitical risk in, 50 years? We still don't have a clue what is going on worldwide.
And Americans feel like this administration and even Congress as well, which there's no policy really by Congress when it comes to the drones that we've seen a lot of outroar by, especially over New Jersey over the weekend. There's no policy, and they feel like the administration is on the back foot, and they were asking for more answers. We had a weekend, we had officials from the FBI, the Homeland Security come out and have to talk about drones over people's homes, shutting down of airports, and it still doesn't seem to be enough to acquiesce people's concerns.
It's just not adding up. I'm serious. I'm sorry. It is just not adding up. They're not a threat. They're over crucial infrastructure. We're not sure what they are, but they're fine. One thing is not adding up with the other, and that's the reason why people are very concerned about why drones are flying over their homes.
So there's two options here. Either they know and they're lying to us, option 1, or option 2, they don't know, and that's pretty scary.
Basically, this is the reason why, and Terry Haines raises this, even if there is an explanation that isn't necessarily China or Iran or aliens, it's going to be probably concerning to people who have lost a good degree of trust that we can really protect ourselves from potential spying incidents like Salt Typhoon, which just affected a whole bunch of different Microsoft outlets. Look, people are looking for what black swan is out there that could potentially disrupt this sense of euphoria that has been in markets. Aside from just a tick up in inflation, which last week was a little bit of a soft patch, there is a big question. What is looming that we do not see? And I think this does not help that at all.
Mysterious flying objects over New Jersey weren't on anyone's bingo cards going into year-end, but that's where we're at. Equity futures right now on the S&P 500 up by 0.2%. Your lineup this hour looks like this. Steve Chiavarone of Federated Hermes looking for the rally in the equity market to continue. Terry Haines of Pangaea policy on mysterious drone sightings along the East Coast. And Sree Kochugovindan of Aberdeen on Germany's political future. We begin this hour kicking off the final full trading week of the year, looking ahead to a Fed rate decision decision on Wednesday. Steve Chiavarone of Federated remains optimistic on stocks. The combination of accelerating earnings growth and rate cuts is rare and generally positive for equities. I'm pleased to say that Steve joins us now. Steve, good morning.
Good morning.
It's good to see you. The equity market rip is on the Nasdaq. It's on big tech. It's not on the S&P 500. It's certainly not on the small caps. We've talked a lot about negative breath. I've been listening to the team over the last week. This was not the bet coming out of the election. So what's gone wrong?
No, I think growth has surprised to the upside since the election. You know, outside of last week's kind of sell-off, the bond market did settle after the election, right? You had that run kind of to 450 on the 10-year, and then that kind of settled back in. But what we think, and we made a move last week in our asset allocation to reflect this, is it's just harder and harder to justify owning non-U.S. developed markets. And I think you've seen capital leave places like Europe, where now you have political instability, not only in France, not only in the UK, but now you also have Germany. They sit kind of at the forefront potentially of tariff risk. Growth has been soft, and so I think you're seeing capital flood in the United States, and it's helping growth. And I think you really saw that last week.
So the risk going into next year, according to Apollo and Torsten Slok, and we'll talk lots about this through the hour. Apollo and Torsten Slok say it's a repeat of 2022. We all remember 2022 was bad for both stocks and bad for bonds. Would you push back against that?
I do. You know, I think this is going to be an interesting week. And I think, you know, Powell, who always likes to surprise us, he may have another surprise in store for 24. And that is, I think the market's gotten a little bit too concerned and hawkish about inflation, right? Inflation has been sticky. It has been a little bit reaccelerant in the last few months. But if you look, it hasn't really broken out of any kind of long-term range. It still appears to be grinding down. And I think you may see a Powell that's a little bit more dovish than what the market's expecting this week, because he does that to us.
Hold on a second.
He does that to us, Lisa.
Yeah, he does this to us. You say he always surprises us. He doesn't surprise us. He outdoves every expectation from the market. You think that's going to be the repeat?
Well, if you look at it, the market has priced in a terminal rate here that's somewhere now between 375 and 4. We still think it's between 3 and 350. That's going to take you into 26 to get there. On the dot plots, right, you generally don't see the Fed erase 2 cuts in one dot plot, right? Maybe they pull one in, maybe they push one out. And so you've got a street that, you know, you've got a Fed with 5 cuts between now and the middle of 26 in their dot plots. You've got a street that only has 3 more cuts. Again, I think what you may see him do is deliver the cut in December, and then talk about how their rhetoric is really about a reduction in pace, not in a reduction in direction. So we're going to go to once a quarter next year, but you shouldn't expect that we're anywhere near the end of a rate cut cycle.
The backdrop to this is that you push back completely against Torsten Slok's point of view, as John was laying out, that basically we're going to have a very inflationary and potentially stagflationary policy where you get growth slowing on the heels of some of these tariffs, but you don't necessarily have inflation coming in. You actually think it's the opposite, that a lot of Trump's policies are going to be more pro-growth and less inflationary than feared. Why?
Well, a couple of reasons. One, I think when you're talking about a tariff, for example, it can't be both a tax and inflationary. It's got to be one or the other, right? Because if it really is a tax, then there's an offsetting demand piece to it. You also have to take into account that tariff increase is likely going to come in the context of major tax cuts. You have deregulation. You have some shedding of government jobs. Both of those can be either certainly pro-growth, but also disinflationary because they take some costs out of the system. And so I think when you put that package together, what's happening right now in the market is we are underestimating the growth that's going to come from the policies and overestimating the inflation. And I think the Fed would be wise to be patient here, see what actually gets through the sausage-making process of Washington. There's a lot of steps to go between a concept and actual policy. And I think if the Fed were to react in anticipation of that, they may end up being more hawkish than they need to be in an environment where the labor markets are softening some.
So you don't agree with Bill Dudley? They shouldn't assume, and they should say, we're going to wait for the policies to take hold.
I don't see what policy you're going to respond to. Now, if you want to respond to inflation readings being a little bit kind of hotter over the last couple of months and then, you know, decelerating to a slower pace of cuts, I think that's appropriate. But again, we've talked about the chess versus the checkers. If you look at each one of the policy proposals that are out there, you can look at it and say, well, this is good or that's bad or that's inflationary or that's pro-growth. when you look at it together, we think what you're going to end up with is something that is more pro-growth, somewhat pro-productivity, and that's going to dampen some of the inflation impulses.
Back to Torsten Slok's note and this idea of rising inflation in 2025. He says the risk is a repeat of 2022, where the 60-40 portfolio underperformed significantly. Can you not use 60-40 next year then?
Well, you got to remember who you're asking. I run multi-asset, which has a lot of those portfolios in it. So I categorically disagree with that sentiment. But no, look, I think what you're going to see is that the bond market and parts of the equity market, I think, have now represent opportunities, right? A bond market that's sitting at 430, 440 on the 10-year with expectations of only three cuts next year, I think there's an upside case there. I think you see the same thing in pockets of the equity market. Some of the hysteria around some of the healthcare names, some of the hysteria around some of the staples names. We look at that and say, we're not canceling drug development in the United States. We are not going to make, snack foods illegal. And so if you have value opportunities there as an investor, those are good contrarian plays, and we're willing to take the other side.
Some of those snack foods should be illegal. But
that's besides the point.
I knew you were going to say
Forgive
that.
Forgive me.
Or just use beetroot instead of BHT.
Maybe. You can make these simple changes. AMH, I'm with you. Should we talk about a bond market? Maybe less about that. This move at the long end of the curve, 10s and 30s, moves of 25 basis points. What do you think is driving that? Is that the data? Is that the expected policy change? Or is the Fed's easing burst contributing to this move at the long end as well?
I think you're seeing one thing I'd say is I think you're seeing a resurrection of the term premium, right? When you have a $36 trillion debt, you're running deficits at the level that we're running them, and you're not concerned about growth, right? The market's not looking out and saying, I've got an emerging recession on our hands. What you're seeing is that the short end is coming down along with Fed cuts. And we think that a term premium is reestablishing itself at some level. Now, that doesn't explain last week's move, but it does explain this idea that our big view, if you want to think about it in terms of the market, really comes from the yield curve. We expect short rates to come down. We expect long rates to stay right about where they are. And what that means is that shorter duration fixed income, 1 to 3 year fixed, we think is in the sweet spot of total return. Equities have duration, right? Small caps have 30 to 50% of their lending is variable rate bank debt on shorter term rates. You buy value names or dividend payers based on shorter term expectations that are discounted with shorter rates. And that's one of the reasons why, last week notwithstanding, we expect this market's going to broaden out and those shorter duration equities are going to see relief. As long rates stay high, short rates come down. We think that yield curve steepening is probably the big market story of 25.
Bond market this morning, bit stable. Yields lower by 2 basis points on a 10-year. Lisa, down about a basis point on a 30-year. Consensus going into Wednesday is pretty clear. The market's looking for a cut this Wednesday, looking for a skip in January. Morgan Stanley confident about today, cautious about tomorrow. Bank of America, Lisa, cut today, pause tomorrow.
Which is a reason why people are looking at the data, because they're saying they're data dependent, just like the Fed. And the data's been confusing. The headline figure coming in hotter than expected, but everyone pointing to the fact that rent and owner's equivalent rent has come in quite considerably. This idea of what happened last week, though, to me was interesting, because essentially any upside surprise and you get the biggest increase in yields in the 10-year going back to October 2023.
Can we agree on this, that food wrapped in plastic shouldn't be edible after 12 months? Should we agree on that? Well, that maybe it's not food. That should be the definition of food. Yeah. That it should probably
you have an issue
go mouldy after
with bread
12
that you
months.
Can sit out on your counter for 2 months.
I don't think you should be allowed to call it bread if it's still.
What do you think you should
still
call
not
it?
got mould on it after a month.
That's a cracker.
Yes,
that's a cracker.
We should call it a cracker.
That's a cracker.
There we go.
All right, come on.
New rule.
Bread.
If the Europeans are listening, they're thinking probably that's a good idea. Steve's good to see you. Steve Chiavarone at Federated. They love the regulations and rules over in Europe. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Drone sightings have picked up in recent weeks, starting in New Jersey and spreading throughout the U.S. Northeast. New Jersey Governor Phil Murphy and New York Governor Kathy Hochul are among those demanding a clear explanation from federal officials. Homeland Security Secretary Alejandro Mayorkas told ABC's This Week that there's no evidence of foreign involvement or that they're a national security risk. Bitcoin has reached a new high again on President-elect Donald Trump's support for digital assets and optimism about MicroStrategy's inclusion in the NASDAQ 100. The largest virtual currency rose more than 3% Monday, topping $106,000. MicroStrategy's inclusion in the index is expected to drive up demand for its shares, allowing the company to raise more equity to invest in Bitcoin. Starbucks hired its first ever chief growth officer in China. The executive is tasked with luring back young coffee drinkers. Starbucks China told Bloomberg it will bring tie-ins with entertainment brands and pop culture icons to market itself. Starbucks has struggled as China's economy slows, with cash-strapped diners having been opting for cheaper local brands where coffee can cost a third of that of a Starbucks cup. And that's your brief, John.
Danny, thank you. Retail sales out of China overnight. Not good. Not good at all. Up next on the program, a mystery in the skies.
I want to assure the American public that we are on it. We are working in close coordination with state and local authorities. And it is critical that we need from Congress additional authorities to address the drone situation.
How much of the American general public think they are, quote, on it? Then conversation up next. Equity futures on the S&P a little bit firmer here by 0.1% on the S&P 500. In the bond market, big sell-off last week at the longer end of the curve. In fact, through the curve, 2s, 10s, 30s. Double-digit basis point move. This morning we're down a basis point or two on a 10-year 4.38. Under surveillance this morning, a mystery in the skies.
I want to assure the American public that we are on it. We are working in close coordination with state and local authorities. And it is critical, as we all have said for a number of years, that we need from Congress additional authorities to address the drone situation. Our authorities currently are limited, and they are set to expire. We need them extended and expanded.
So here's the latest this morning. Drone sightings in the Northeast picking up in recent weeks. New Jersey Governor Phil Murphy, New York Governor Kathy Hochul demanding a clearer explanation from federal officials. Terry Haines of Pangaea Policy writing, China's ongoing US telecoms hack, the drones mystery, and the weekend incident at US Cyber and Signal Corp's HQ, singly and together, are significant market negatives. Terry joins us now for more. Terry, I'll ask you the question that we posed going into the commercial break. How on it do you think the government is?
I think the government is. The government represents. How about that? That it is not on it at all. You know, whether you've got Admiral Kirby doing his best Kevin Bacon and Animal House impression, you know, all is well. You know, Mayorkas, who told us the border was secure and then it wasn't, now it is, and then it wasn't. You know, and I could go on about the administration, but they have done nothing to reassure people here. And you know, it's the telecom hack is one thing. The you know, for example, but I think that's the most clear and present danger. But you know, the fact that the government flat out admits it can't do anything about it in the short term is nothing short of astonishing, and not designed to bring confidence to either the public or the markets. That's for sure.
Terry, you're questioning the credibility of the Biden administration, which the Wall Street Journal editorial board does as well this morning, saying that the admin has squandered its credibility to the point that it's rational not to believe what it says. And it goes on to say, remember the Chinese spy balloon when they were trying to court better relations with Beijing, saying, don't look here, it's not that big of a deal. Who has credibility right now in Washington to potentially ease the concerns of Americans, especially those in New Jersey that are seeing drones over critical infrastructure?
You know, I guess I haven't read the Wall Street Journal editorial, but plus one there. Nobody's got credibility, frankly. You know, and pretty much on any subject. You've got, you know, Mayorkas, the clip you played coming in reveals a lot. And one of the things that it reveals is that the administration has a bad conception of its own job. This is a guy who runs the Department of Homeland Security. So, you know, doing everything about Homeland Security is the first requisite of the job. And instead, what he wants to say is you know, Congress hasn't given us enough authority. Well, you know, you run the Department of Homeland Security, go make the Homeland secure, and, you know, kind of worry about the niceties later. Maybe Congress will run you in. You know, instead, what they want to do is spend a lot of time pointing fingers and telling people that, you know, it's really not their job, it's somebody else's job. That alone, I think, is a very, very bad sign.
Well, there is no policy by Congress, and there's a lot of finger pointing done now, retrospect, and who should have been doing this. But what policy should Congress actually maybe work on?
To the extent that there are actually holes in jurisdiction, you know, they should make sure that those are federal, make sure that those the military has the ability to do what they need to do, make sure that the National Guard is involved, civilian authorities are involved. But the administration essentially sat around, as you point out, ever since the Chinese balloon, and did nothing about this, did nothing to push anybody on this. And so I think it fundamentally lies at the feet of the administration to not push Congress to do anything. I mean, look, we've got a continuing resolution that can be passed this week by Congress before they go home. It wouldn't be too much to ask that they could do some of this stuff and put it in that CR as a response. But, is the Biden administration interested in doing that? Is Congress? They're not. I think it's a failure all around.
Terry, there's a larger question here, and I think this is what you're getting at in terms of just a vacuum of power right now in Washington, D.C. How perilous is that vacuum of power at a time where there seem to be some real imminent threats, whether they are acknowledged or not, that seem to be hovering over the psyches of a lot of people in the market, at least?
Yeah, sure. And full marks for the hovering there, by the way. That was good. The interregnum here is very perilous in a lot of different ways. And, what you've got is a situation where the Biden administration professes it's doing things, but in fact isn't, and blaming other people. The incoming Trump administration, meanwhile, says that, according to the incoming National Security Advisor, Waltz, says that they are also on it and that they are coordinating with the Biden administration. My view of this, for what it's worth, is they being the Trump people, ought to be taking a much more aggressive view of this. If they can start changing foreign policy, if they can start changing trade policy even before they're in office, they can certainly light a fire under the Biden people and do something about national security even before they get there, and get credit for it, by the way. Well,
Trump is trying to light a fire under it, writing on Truth Social over the weekend. Mystery drone sightings all over the country. Can this really be happening with our government's knowledge? I don't think so. Let the public know now, and otherwise shoot them down. And then there are a series of articles explaining why it's dangerous and illegal to shoot down property that's flying over your house. And I'm just wondering, from your perspective, how this is going to play going into the end of the year. What are you watching for?
I'm watching for any progress on any of the things we just talked about, whether it be the telecom network, which, as I say, for markets, I think is the most disturbing, since markets rely on telecom networks, whether it be the drone thing, whether it be the incident at Cyber Command over the weekend, any of these things. But what I'm looking for is anybody to not make politics out of this, but to make progress on informing the public as to what is actually going on and why it's going on. We're reaching a point here where the public needs reassurance, and it's in the public in this case is being led in part by the skepticism, or worse, from state governors, many of whom are Democrats, who would normally be trying to do what they could to support the Biden administration, but here they're not at all, which alone tells you how alarming this is. So real progress needs to be made on this before the inauguration, and right now I think people are just coming to grips with it, and people who are in decisional perspectives and places are just coming to grips with that, and that's too slow.
Yeah, the time to try and support the Biden administration, long gone. Now, Terry, thank you, sir. Terry Haines of Pangaea Policy. Bramo, I don't think anyone advises private citizens to get on the roofs in New Jersey and attempt to shoot these things down, but I'm with you. The power vacuum right now. We've revisited this every 4 years, and we'll continue to do it every 4 years for the next several decades. The wait until January, late January, to change things out. I'm very critical of politics in Europe, hypercritical of politics in the UK, but there is one thing they do well in the UK. There is an election, there is a change of power, 24 hours later you're out and someone else is in.
It's even more important when you have such animosity between the two parties. So it's not as if everyone can say, kumbaya, we've got things flying up there, let's get together. It seems like you have some people saying shoot them down, other people saying we have this under control, while an entire fire, a dumpster fire, goes behind them. So, not exactly reassuring.
Over the weekend, though, you saw Democrats and Republicans speaking from the same tune. Something needs to be done. Amy Klobuchar was on Face the Nation saying you have to register a drone if it's over half a pound. So if they're registered, come out and tell us who these drones belong to.
I imagine they're not, or maybe they are and they're not telling us. I haven't got a clue. The fact that we can't track them, that's a big problem. Up next, Sree Kochugovindan of Aberdeen. From New York, this is Bloomberg. We're almost there. For many of you, it's like 5 sessions away. We're almost there. Equity futures on the S&P up by a little more than 0.1% on the S&P. On the Nasdaq 100, up by 1/3%. On the S&P, this from Jonathan Krinsky of BTIG. I know you're all citing a similar theme. Every day in December has seen negative S&P 500 breadth so far. The fact of the matter is, coming out of the election, we were looking for a rally to broaden out, looking for the small caps to perform. Small caps are down for 2 weeks. Nasdaq 100 is up for 4. That's the run we've seen on big tech.
A number of measures of bad breath, and I just can't stop thinking of terrible jokes. I'm sorry, you're doing such a good job.
What, taking the D out?
Yeah, obviously. Like, this market has bad breath. You
Okay,
know,
got
it's
it.
like, you know, that's been sort of...
Was that humour in this market last week?
that was market humour.
The edge of SNL.
Let's move on. All I can say
High-end
is
comedy.
you've seen some pretty the lowest correlation or the lowest breadth going back to 2001, and it raises this question of, does that portend some sort of decline, or is this just sort of a knee-jerk response to the idea that we haven't necessarily seen yields bottom out? I'm trying to keep going here.
Nice to see Chris Rock back, wasn't it?
It was.
Actually trying to make SNL funny again.
Yeah, he was good. I thought he was good.
Can we do that? Can we make SNL funny again?
I think that there could be segments, yeah.
Okay, cool. Just a few segments here and there.
All I can say is, I don't think I'm going to be the one doing it, as everyone just watched.
Let's turn to the bond market. Sweat Bramo loves to beat. 2-year, 10-year, 30-year. Yields are lower this morning by a basis point or 2 across the curve. Yields were materially higher through last week by more than 20 basis points on a 10-year and a 30-year. And lots of discussion, Lisa, over the weekend as to why.
And basically the idea here and coalescing around this, and Steve Chiavarone pointed to it, is that, yes, this is a Federal Reserve that is going to cut by 25 basis points on Wednesday. That is consensus. The consensus is shifting to them being more hawkish when it comes to what they project for next year in terms of the revisions to the Statement of Economic Projection. And it seems like there is a coalescing around the idea that the neutral rate is going to be materially higher than what it has been in the past. And you can see that reflected in the yield curve and in the long end.
Reflected in the US dollar as well. The dollar index, DXY, has only had one down week through the whole of the fourth quarter so far. Another up week last week. Euro dollar right now looks like this. SocGen just reporting right now that Europe is stumbling towards 2025. I think we all agree with that sentiment. Euro dollar, it's a break of 105, Lisa. 104.90. We're down 0.1%. Mark Wall over at Deutsche Bank reflected on the ECB meeting of last week. A group on the council is already proposing 50. The policy stance is still restrictive. Tariffs have not been factored into the ECB forecast yet. And the new language allows for the possibility of rates having to fall below neutral. So if you just remove Lagarde at the news conference and just take away everything else, it's setting up to be a pretty dovish ECB for 2025.
And that's typically the way you like to do it because, frankly, Christine Lagarde hasn't necessarily been on the front foot of signaling as far as what the ECB is going to do. Now the question is what the policies are actually going to be and what this means going forward at a time where you have the likes of Morgan Stanley saying they think this is a first half of the year story in terms of dollar strength. But once you start to get the implementation of some of these policies, you could see a reversal, especially if you do get disinflation that reasserts itself as a result of some certain particular tariffs.
Euro dollar, 104.90. Under surveillance this morning, the data out of China, not great. The resale sales growth weakening in November, figures rising 3% from a year ago. The slowest pace in 3 months and undershooting even the most bearish of forecasts. The data highlighting the urgency for Beijing to once again encourage residents to spend. We've had a few head fakes on this front over the past few months.
And this is leading people to believe that the head fakes are from a number of other countries, namely in the United States, bringing forward demand for goods ahead of the potential implementation of tariffs. That is a sugar high, and it's not necessarily masking what's going on underneath, which is that consumers still aren't spending.
This comes also after policymakers said the second time in only a decade that they really want to boost consumption. But to be honest, there's been so many head fakes, it still feels like the Chinese consumer of the strict lockdowns of the pandemic. China has not been able to actually recover from the pandemic, and we are years out.
You know the big curveball from last week? I think it's the Reuters report on what they're going to do with foreign exchange. Got no idea how much weight you should put on that report from Reuters, but ultimately indicating that top leaders and policymakers are considering allowing the yuan to weaken in 2025 as they brace for higher US trade tariffs. That a quote from Reuters just last week.
At a certain point, that suggests they're just going to lean into the one aspect of their economy that's been working, which is the export factory and cheap exports at a time when that is the one thing that keeps working. Key question is, how high will the walls be elsewhere? This brings a point up for Europe.
Watch this space. Speaking of Europe, Moody's cutting France's credit grade, citing concerns over the country's public finances and high deficit. This coming just hours after President Macron appointed François Berro as the country's prime minister. This, I have to say, is like, where have you been, Moody's?
Exactly.
Where have you been?
S&P and Fitch already had this rating level. So why is Moody's coming out after the political paralysis and the fact that this country cannot pass a budget? Deutsche Bank comes out and says their commentary, Moody's, on future deficits is quite damning. But the fact is it's a stable outlook for now and just brings it in line where S&P and Fitch are. So Moody's is a little bit late to the game, is fair to say. All I can say is the fact that people were taking comfort that they weren't on watch for downgrade further tells you the state of play. I saw a number of relief messages, okay, it's not that bad. It's just a downgrade, but at least they're
but
not,
that's the bar for Europe in 25, Bramo.
Exactly.
We're both on the same page. How little needs to go right for this market to move the other way?
That is the contrarian trade for 2025. Because at a certain point, you think about all the euphoria baked into the United States. You think about basically China left for this paralysis that we just saw. You see Europe left for dead. Maybe they don't have as bad of a budget deficit for a quarter, and all of a sudden people flood in. I mean, how much are we sort of setting up for that type of action?
That's France. Here's the latest on Germany. The Chancellor Olaf Scholz facing a parliamentary vote of confidence later on today. Scholz expected to lose, triggering a snap election on February 23rd. The new Chancellor facing a host of challenges, including a slowing economy and Russia's war on Ukraine. Bloomberg's Ollie Crook joins us now for more. Ollie, welcome to the programme. Fantastic reporting on the issues that Germany's facing over not just the last few weeks, but the last several years. Ollie, walk us through the next 24 hours before we get to the big issues further down the road.
Yeah, Jonathan, this all really began on November the 6th, really hours after Donald Trump was elected president in the United States, which, by the way, was very bad news for the political establishment here in Germany. Olaf Scholz firing his finance minister, basically disagreements over the budget, how to spend the money. And guess what? In an environment in Europe where you have basically zero growth, those budget negotiations become really, really tough, and they bring down governments, not just in Germany, but also in France. And here for Olaf Scholz today, that sort of governability question will be put on in full right behind me in the Bundestag at 1 p.m. He will go to the stage. He will deliver a 25-minute speech before lawmakers. A 2-hour debate between all the lawmakers will ensue after that. Then a sort of line vote, after which we get basically the outcome of the no confidence vote at 4 p.m. our time, at which point he can go to the president and basically dissolve the government, paving the way for that election on February 23rd. When we think about all of the issues that Germany is grappling with, we had PMI data out earlier today. Manufacturing still deep in contraction, 2.5 years of contraction. When you think about what these parties are presenting in terms of an economic platform for really changing things here in Germany, there is a sense to many people that I speak to that they're trying to treat cyclical disease with a sort of cyclical cure to a structural disease in Germany, all of the issues that you have underlying. And I think that that takes us really presently to the debate around the debt brake, which, by the way, Merkel just came out with her book. They brought the debt brake in 2009. They put it in the Constitution. That takes 2/3 majority to change. She says that that needs to be reformed. And what we're seeing from the platform from the CDU currently leading is that they will not move on the debt brake.
So just to be clear, even if there is new leadership, there are still a number of people and a majority that want to keep their commitment to not increase their deficit as they face off with a stagnant economy or a declining economy in the face of real structural change. Is that correct?
And I think that that is the main question, is what is the point of having these really, really low borrowing costs if you don't use them when you need them? And yeah, that is basically the issue. But this is an issue we've seen across German politics historically. I mean, this is a country that shut down their nuclear energy capacity in the midst of an energy crisis. So you have a lot of these parties that have these very, very strict rules that are really unwilling to budge. And that has been part of the problem, is why this coalition did not succeed and fell apart just a couple of weeks ago.
Ollie, appreciate the update. No doubt we'll catch up tomorrow morning. Ollie Crook there out of Berlin this morning on the latest with the politics in Germany. Every road paved with failure seems to lead back to the German Chancellor, Angela Merkel.
She had a beautiful view of globalization and exporting to China and buying cheap goods from them and gas from Russia. Well, not exactly the panacea that we're looking at now. But why not increase the deficit? I just don't understand this. Maybe I'm just American.
Well, they have a debt brake, and it's meaned years of underinvestment when it comes to infrastructure, when it comes to defense. You cannot talk about the current state of German politics and the German economy without talking about the legacies of Angela Merkel. And you mentioned Russian gas. That's one of the biggest ones. Basically, you had a Germany enslaved to this cheap gas that was able to boost their manufacturing space. They have yet to come over these policies, debt brake, Russian gas, and it's just mean more political paralysis in Germany is going to continue.
It's an economy with huge structural problems. Let's talk about them right now with Sree Kochugovindan of Aberdeen. Sree, huge problems in Europe. Are they the kind of problems that the ECB can address?
I think the ECB has a very challenging outlook. You've already outlined a lot of the structural headwinds for Germany. And I think the political stasis that we're seeing is going to be something to monitor. But as you say, it's very difficult to generate growth in this environment. This morning, we already had the flash PMIs for both Germany and France, which were nudged higher, but they're still in contractionary territory. And we can see that divergence between manufacturing and service sector. And Germany being the engine of European growth and manufacturing being such a big component for driving German growth, I think the outlook there does look quite sluggish. So we are looking for relatively sluggish growth from the euro area going into 2025, 2026. And that is going to mean that the ECB will be dovish going forward. And we are expecting another four cuts from the ECB, and with rates settling around 2% by the second half of 2025. So they're going to be quite quick in terms of their easing path, very different to some of the other countries, particularly US, which has a very different growth backdrop. So as a way of growing out of a fiscal issue, that's something that is going to be challenging for euro area as a whole.
Sree, just to stay on Europe, do you think the fate of the European economy is in the hands of the European policymaker? That's the bigger question. Or are they at the mercy of what happens in China, what happens with US policy?
I think that's a very good point for next year. That's one of the big challenges, one of the risks that we have when we create our scenarios, our base case and our scenarios for investors. It is looking at the trade challenges going forward. Some of those trade barriers that are being discussed, just hinted at so far, nothing concrete just yet. We don't quite know what's happening in the US economy. And that's something that other central banks are looking at, including the ECB. We already had Christine Lagarde mentioning about a month ago, mentioning how we may need to shift our consumption patterns within Europe and maybe have to import other goods from the US. So there will be a degree of negotiation from policymakers, but that's very separate from the ECB. And what the ECB, the tools that they have, will be primarily through monetary policy and really through easing rates. And that will be, obviously they're going to say it's data dependent, but for now it does look like a fairly aggressive pace of easing. And that's something that they will have to do in order to help just shave off some of the bigger risks that the euro area are facing at the moment.
I want to just sort of build, though, on what John's getting at, which is if they cut, will they borrow? Right? I mean, basically, when you talk about a divergence between the U.S. and Europe, one of the key issues, we were talking about it with the German government, you can have really low rates, but governments and sometimes even companies won't borrow that much in order to invest and really innovate. If the ECB is accommodative, how much will that actually boost growth, boost the prospects for the region, and even give stability to the region's currency?
Yeah, I think in terms of the private sector, investment does need some certainty. And there are so many challenges. Domestically, you have political challenges. Globally, you have political challenges. Again, the uncertainty around the trade parameters are going to, unfortunately, be a headwind for investment from the business side over the course of next year. So we need to see some clarity, and we're not going to get that until the second half of the year, realistically. And in terms of government borrowing, obviously, you've already discussed the debt brake is a challenge there. And it really depends on the makeup of the government after the February 23rd election. If you get to see some sort of coalition with the Greens, perhaps CDU and the Greens. However, that still, we have parties that are very much against changing the debt brake. So that is going to limit the amount of borrowing from the government there. So that's a challenge. And you're absolutely right. This is the time to really think about innovation and encouraging innovation from the corporate side in order to keep up with competitors in China. And the car industry is a prime example of that. The fact that the engine of German manufacturing is facing some big headwinds in the fact that transition from ICE to EV has been lackluster relative to China, which is miles ahead, and also other automakers across Asia. So I think that is a key challenge that needs to be addressed. Whether they'll address it next year, it's going to be very, very difficult to see that happening.
When it comes to addressing these challenges, do you see Europe acting in a bilateral stance with the United States, especially, or do you think Brussels will speak with one voice?
I think it will be with one voice. As it stands over the course of 2025, There is a risk to that. You're absolutely right in flagging it, where we have the far right parties in France, in Germany, stating that they are going to be, they're even challenging the concept of the European Union. I think fragmentation risks are limited for now. It was very different. The situation of Brexit was very different in the form of the referendum and the way it was set at a very simple 50% level of winning or losing that argument. So I think that needs to be taken into account. Fragmentation risks are still marginal for now. But there is going to be some fairly loud voices in play. But I think ultimately what we saw in the 2016 Trump administration was tariffs being used to negotiate. We'll put on tariffs unless you shift your migration laws or you buy agricultural goods from us. There will be a period of negotiation there. And that's something that Europe is better to do as one voice. And there will be some challenges from these individual parties. But at the moment, it seems that that one voice is still possible for the course of 2025. And next year is key in terms of setting the outlook for the next 5 years, actually, given these trade parameters moving.
Hey, Sree, thank you. It's good to hear from you, as always. Sree Kochugovindan there of Aberdeen. What will it take, Lisa, to end Germany's love affair with fiscal austerity?
Yeah, you're asking me. I think you need a therapist for that.
It's deep in the fabric of the German government. It's well documented. I remember when Wolfgang Schäuble, the former German finance minister, stepped down, and hundreds of employees of the ministry went outside dressed in black and made the shape of a zero for him. The black zero is deep in the fabric of that government.
And this goes straight back to the 1930s and what happened after World War II and after World War I. And it goes to this idea of we never want to see that kind of inflation ever again. And the scars of that go deep. At the same time, you think about all the people calling the American style evil in terms of spending more than you, borrowing more than you can spend. And, there's moderation here.
Euro-dollar, 104.87, turning negative on the session. We're down about 0.1%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Starting with an update on the deadly shooting of United Health CEO Brian Thompson. Police claim to now have overwhelming evidence tying suspected gunman Luigi Mahajan to the fatal shooting. He hired high-powered New York defense attorney Carrie Friedman Agnifilo to represent him. She could argue an insanity defense or challenge the evidence and may consider a guilty plea to reduce his potential prison term. Former House Speaker Nancy Pelosi is recovering from hip replacement surgery. Pelosi's office confirmed that the surgery took place at a U.S. military base in Germany. Pelosi, who is 84 years old, suffered from a fall on Friday in Luxembourg during an official trip and then was hospitalized. Her office did not describe the details of the severity of the injury, but added that she is well on the mend. And Tesla shares, those are moving higher just slightly by 1/3% after hitting a record high on Friday. Wedbush analyst, maybe to no one's surprise, Dan Ives raised his price target on the EV maker to a street high of $515 a share from $400. His bull case, though, is $650 or a $2.1 trillion valuation. Ives wrote in a note that the Trump White House will be a total game changer. And that's your brief. John.
Danny, thank you. We'll talk about Tesla later on the programme, about 8:15 Eastern Time. Tom Narayan of RBC. Look out for that. Up next on the programme, betting on a December rate cut.
January is probably going to be a pause. And that's really what's priced into markets. Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
That seems to be the consensus right now. We'll talk about that next on the programme. Live from New York, you're watching Bloomberg TV. Live from New York City, welcome to the programme. The state of play, your scores look like this. Equity futures on the S&P up by 0.2%. A rally, a bid returns to the bond market. We're down 2 basis points on a 10-year, 437.30. Under surveillance this morning, betting on a December rate cut.
The number of rate cuts that they show in 2025 will go down from last time. All those things together will make it pretty clear that, January is probably going to be a pause. And that's really what's priced into markets. Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
So here's the latest this morning. Investors gearing up for a busy week of economic data. Global PMIs today, followed by retail sales on Tuesday. And a main event on Wednesday, a Fed decision and Chairman Powell news conference. Nela Richardson of ADP joined us now for more. Nela, good to see you. Good morning.
Good morning.
The word of the year for you with regards to the labour market is stability. And I wonder how much stability we'll actually have in 2025 for this Federal Reserve.
Not much, in my view. I mean, the labor market is stable if you look at the main features of it. First of all, workers are staying put. Layoffs are very low by initial jobless claims. Hiring has been robust. The second thing we're looking at is pretty stable wages, but at an elevated level. And that's going to put pressure on the Fed as it seeks this 2% target. But even though wage growth has been at levels higher, people are working less. So for hourly workers, which make up 60% of the labor market, their pay is not keeping up with inflation. So there's this undercurrent of instability within the overall stable labor market. I don't think it stays stable in 2025.
So what hints are you getting of which direction it'll go in? Come on, just tell us where we're heading with this. Where is it going to break?
For the Fed or for the labor market?
Labor market.
I think what you're going to see is a little bit of hesitancy as you round the corner in January to admit new administration, potentially new policies. I think you're already seeing some hiring kind of back off when it comes to smaller firms. So we're watching that very closely. And if you tie a stable wage growth pattern with sticky inflation, what you're going to see is workers who are not as happy as they've been over the last few months. And we're already seeing that in our worker sentiment data, that kind of loyalty to their employer, that enthusiasm about work is starting to slip.
And how much is that the same on the other side? I mean, I think about the M&A boom that people are talking about. How much does M&A tend to lead to layoffs when there are certain efficiencies of scales?
That's a great question. We're expecting that activity, and we're going to be watching very closely about what the overall mark on the labor market will be. You would expect that there's going to be some churn, whether it's layoffs or people actually voluntarily quitting, as also happens during mergers and acquisitions. That might put some, churn in the labor market, which actually leads to higher wage growth, not lower. So something to watch. And again, it all circles back to inflation.
If more workers are staying at their current jobs, how hard is it right now to find a new job? Is it taking a lot longer?
It is taking a little longer, especially for college degree holders. And I think this is the shock and surprise of younger workers, new college grads in this year's market. They were used to what they heard from their friends who graduated 2 years ago, snapped up by the labor market. That's not happening. It's taking a little bit longer to get that job.
Is that because the employers just don't have the job? Or some of this, can we start saying, maybe is down to AI and more efficiency?
AI is going to affect where it's going to sink in is at those entry-level jobs, and that's true across industry. So excellent point there. We're not sure if that is actually happening right now because companies are still trying to implement their AI policies. What we're seeing is a slowdown after record high hiring in the last 2 years, and those college degrees just not getting. I tell young people when they contact me, and they often do, that networking is back in style.
Yeah.
Networking that may have been lost 2 years ago with this digital economy. You throw out your resume, somebody catches it. Now you might actually have to talk to someone face to face. And for Gen Z, that's a new skill to learn. Good one, though.
Top tip for the class of 2025. Don't take advice from the class of 2021.
100%.
Don't take any advice whatsoever.
It's a different labor market.
Very different. A lot has changed. Nela, it's good to see you.
Thank you.
Nela Richardson of ADP. Up next on the programme, Kelsey Berro of JPMorgan Asset Management, Henrietta Treyz of Veda Partners, Will Vanloh of Quantum Capital Group, and Simeon Gutman of Morgan Stanley. With equity futures just about positive, the second hour of Bloomberg Surveillance is up next.
On the equity markets, I see some froth. I'm a little bit nervous.
I would expect markets to broaden out largely because the earnings differentials are likely to moderate.
You want to be positioned in parts of the economy that are growing and also have a high share of domestic revenues.
The consumer resilience is not waning. So they still have some cushion in there across all income cohorts, high, middle, low.
The markets are confused just as the Fed is about the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Here's a snapshot of the price action, both in equities and bonds, and then we'll get to the week ahead. Equities right now positive by 0.2% on the S&P. On the Nasdaq 100, a 4-week winning streak for big cap tech. The Nasdaq 100 up again this morning by a third of 1%. Last week, a sell-off in the bond market. This morning, just a little bit of a bid. Yields are down by 2 basis points on a 10-year after climbing by more than 20 last week. The 10-year at 4.3730. The next big stop for this market, the economic data through the week, including U.S. retail sales tomorrow morning. And then the big one on Wednesday, Bramo, is the Fed decision and Chairman Powell news conference.
Amid a confusing set of data that really gives still a lot of ammunition to both the people who want to view this as a disinflationary environment and those who want to view it as an inflationary environment. Key question will be how the Fed paints the picture into 2025, how much they accept some of the policy as fact versus, say, wait and see, and how much that trickles into their statement of economic projections.
Mohamed El-Erian just publishing on Bloomberg Opinion this morning, talking about that exactly. The debate is not about what happens this week. It's about what comes in January. And he says many anticipate the skip will be followed by a resumption easing. Some think potentially you're going to have a skip and then a very long pause. Very few. But maybe once we see more of Trump's policies flesh out, like the Peterson Institute will say, you know what, it's going to be a pause and then potentially a hike.
Adam Posen started this conversation months ago. I would say that Torsten Slok of Apollo is picking up the baton and writing the following. Recent inflation readings show signs that the decline in inflation has stalled. There is a risk of re-acceleration. He goes on to say, for investors, the big risk for next year, a repeat of 2022, where it was painful for both bonds and for stocks alike.
And we saw a hint of that last week. I mean, let's be clear. The sell-off that we saw in 10-year yields was not sort of an all-of-a-sudden momentary thing. It wasn't from failed auctions. The auctions were fine. This was a steady grind higher as people reassessed what the stickiness of inflation would be over long term and what the neutral rate would be. There is a real fear that we are underestimating the inflationary impacts of supply chain disruptions, but more importantly of immigration and the workers and the potential for salaries to really lead the increase. And that, I think, was really giving some people pause.
That's one part of the story. The second point supports that. It's the easing bias of the Federal Reserve at a time when you're seeing those things develop that I think is contributing to longer yields at the long end on both the 10 and the 30-year. When you hear people like Chris Waller, Fed governor, come out and say that they still believe they're a long way from neutral, that there's a lot of work to do just to get back to neutral, I think that speaks to an easing bias that still grips this Federal Reserve, regardless of what they signal for January.
And it raises a question of whether there truly is signal on the fact that the long end has risen in terms of yield so much since the Fed cut by 50 basis points. That still is a mystery. Is that simply analogous to what we've seen, or is there something more here that people are really looking at and saying, hold on, maybe they're going a little too soon?
Things are a little bit calmer this morning, at least. We're down 2 basis points on the 10-year. Let's call it 4.38. Coming up this hour, we'll catch up with Kelsey Berro of JPMorgan as investors await Wednesday's Fed decision. Henrietta Treyz of Veda Partners as Congress looks to avoid a pre-Christmas shutdown. And Will Vanloh of Quantum Capital Group on the outlook for energy under a second Trump term. We begin this hour with stocks higher and bond yields just a little bit lower as markets await the last Fed decision of 2024. Kelsey Berro of JPMorgan writing, it is time to stop worrying about whether the Fed can continue cutting interest rates. Our New Year's resolution for investors is to embrace the current bond market, one where the zero lower bound and negative yields are becoming distant memories. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
Can we start with the moves of last week? What do you think underpinned that move at the long end, on a 10-year, on a 30-year?
Yeah, so it is interesting. The move last week, I don't really think was connected to anything specific as it relates to the auctions. Lisa, as you mentioned, the auctions were fine. I actually think the data is generally still consistent with the Fed's current easing bias. So my interpretation of the inflation data, I actually think that they're going to see that and think on the margin it's actually positive. Because when you look at the read-through of inflation to core PCE, which is their preferred measure, it's actually going to be softer in November. And I think the key thing they were looking at in terms of the inflation data last week that was really monumental, that people aren't really looking at, I don't think as much as they should, is the step down we've seen in shelter inflation. So that shelter inflation, that renormalization of OER and primary rent back to pre-COVID levels, that's not fed through to the year-over-year rates. So if that continues, and I'm not saying shelter inflation is going to slow further from here, just maintain its pre-COVID trend, you have disinflation in the pipeline on a year-over-year basis that's going to bring core PCE closer to 2.25 by March. So again, there's different ways to interpret the inflation data, but I actually think the inflation data has been telling the Fed we stalled on progress for a little bit, but things are generally going in the right direction. So that brings us back to why were yields higher last week. I think people are setting up for the potential for the Fed to sound hawkish, and I think that that's probably already in the price. And now we may be looking at more of a potential, if the Fed were to surprise either way, it could actually be to the dovish side because the market's only pricing 2 cuts next year. And for the Fed's perspective, I don't think that they've seen a lot has changed yet because they can't, and the market's forward looking. The Fed, on the other hand, they're still stuck in the information that they know.
The consensus view is to cut this week and to skip January. Do you challenge that?
So I think it's a fair base case. It's in line with our base case. But when I look at the probability of January being lower than 25%, that I think, that could still shift between now and the next decision, dependent on the data we get, particularly on the labor market. So the labor market data has been incredibly choppy, but as your last guest mentioned, beneath the surface, it's taking longer for people to find jobs. The unemployment rate is actually creeping back higher to where it was over the summer. That's the reason that the Fed is really, focused on maintaining this easing bias, despite the fact that inflation has taken longer to get back to target.
I guess a real tell will be if the Fed does act in a more dovish way and signal something that is more dovish than the market was expecting. Do you expect the long end of the yield curve to rally or sell off?
I think it's probably stable around here. So I wouldn't expect a big move in either way. But I would say, in terms of our risk budget, where are we putting risk to work in our portfolios? We've actually been staying pretty neutral as it relates to U.S. duration. Where are we putting risk to work? One, on the curve. So I still think there is scope for the curve, the U.S. curve, to steepen. Maybe it would be a bit of a twist steepen where you have the front end fall and the long end rise. And then also, if you're not buying duration in the U.S., we're still fixed income investors. What we do is we buy duration and we're buying it in other places. The UK, Europe, and more recently Australia. Australia is one of the last central banks that hasn't started their easing cycle yet. So there's plenty of other places, to look at.
You make a legitimate case for the U.S., but it's complicated. When you start talking about the yield curve and exactly how things are going to respond, it's not the clean case of an ECB that's talking about the potential for not necessarily not just not restrictive, but even easier monetary policy. When you have a Swiss National Bank policy president talking about negative rates, no one likes them, but, they work. So at what point do you just sort of forget about the U.S. and go Europe, go Australia?
Right. And that's essentially what we're doing. So, you can stay fairly close to home as it relates to the U.S. right now and wait for larger dislocations and take that risk budget and put it other places. The other place that we continue to lean into is credit. Credit has performed very, very well this year. And so, one of the things that we've been focused on, there's a lot of airtime, and I contribute to that airtime on the Fed. And the fact that, the Fed has cut, but not nearly as much as what people were anticipating at the start of the year. That's actually been a good thing, because it reflects the fact that economic growth has been extremely strong. And if you were to invest it in high yield at the start of 2024, you're looking at high single-digit returns. You got the carry, you got a little bit of spread compression, and that's still an area where we see a lot of opportunity.
Triple C spreads pushing 9 in the summer, now have a 5 handle. What's going on with the riskiest part of credit?
So in the riskiest part of credit, there's a lot of more idiosyncratic stories within the telecom sector, for example. And those are places that, you really need to understand the specific company fundamentals, company situations that are going on. But I would say more broadly about the high yield universe is that it is so much cleaner of a universe than it's really ever been. And the way that, I think is really striking to look at it is to look at the divergence between defaults in high yield versus defaults in leveraged loans. Those have diverged. Now, both are still low. But really, the high yield universe is extremely clean. And that's why, when I look at spreads that are so tight, is it justified by the fundamentals? I would say it is.
Rational or irrational exuberance gripping the credit market, Bramo, which one is it?
You know, a key structural question is whether the private credit market puts a floor under the quality of the public credit markets, including CCC. And it's the reason why people are talking about a very different quality of the entire high-yield public market that is different than the previous one. How much is that what's at play here?
I mean, I think that is definitely a significant story. So if you just think about the growth in private credit, it's gone from something that was, very small relative to the high yield and syndicated loan market to one that rivals the size of the two of them. So it is a legitimate and full asset class. And so the trends have changed. And so just to compare, the index spread on high yield today versus the history is missing the point because the index itself has changed in terms of the quality.
And John, there's been this whole restructuring where basically you took all of the private debt and you put it in the public hands. And basically you've seen leverage balloon in the public market, U.S. government, sure. And everyone else looks a lot better. And essentially there's this question of, can you really have your lunch and eat it too? And everyone's thinking, yeah, I think so. We're going to buy some credit.
You cited quality, but I cited CCCs directly. Are we saying that CCCs aren't what CCCs used to be?
Well, in CCCs, again, it's very idiosyncratic and company specific. So we're actually quite involved in that space. But you have to have the resources, the research desk, the people who understand the law aspect of it, the litigation aspect of it. And so, that is a really specific pick your spots type of situation. So the way that we've been doing it is kind of a little bit of a barbell. So you choose your spots in CCCs where, we're involved and we're active in the negotiations of restructuring. And then on the other hand, you have the companies that we feel really comfortable about more on the higher quality side of the high yield market.
Credit spreads are super, super tight. Kelsey, it's good to see you. As always, Kelsey Berro there of JPMorgan. Equity futures are positive by about 0.2% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. South Korea's parliament has voted to impeach President Yoon on Saturday, following his brief martial law declaration earlier this month. With his duties now suspended, Yoon awaits a ruling from the country's constitutional court on whether he will be removed or restored to office. That decision can take up to 180 days from the passage of the impeachment. Bloomberg has learned that Apple is developing a giant foldable iPad-like device. The company is aiming for a 2028 release of the product. It would unfold into the size of 2 iPad Pros. Apple's goal is to avoid the crease that current products have when the screen is opened. Apple is also exploring a foldable iPhone. And the Kansas City Chiefs trounced the Cleveland Browns 21-7 with Patrick Mahomes throwing 2 touchdown passes before leaving the game with an injured ankle. The Philadelphia Eagles beat the Steelers 27-13 for a franchise-best 10th straight win. The New York Giants, though, suffered a franchise record-tying 9th straight loss to the Baltimore Ravens. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, a spending fight on Capitol Hill.
Where anybody's going to be willing to cut is anybody's guess, and the deficit just keeps getting bigger, and the overall national debt keeps getting bigger. Sooner or later, that debt will catch up with us.
You see Janet Yellen in the last week or so regretful they didn't do anything about it.
Very regretful, although she was in a position to talk about it in a different way for years, but waited until the way out to say someone else's problem now.
It's like catching people at 3 a.m. stumbling out of a nightclub. Regretful that they drank too much. What does that even mean?
The walk of shame. It's the walk of debt shame.
My goodness, that's nice. I like that.
Thank you.
From New York City this morning, good morning. Just a snapshot of financial markets stateside, both in equities and bonds at the moment. Equities okay, up 0.25%. Bonds rallying 2, down about 3 basis points on the 10-year, 436.91. Under surveillance this morning, a spending fight on Capitol Hill.
Offsetting costs seem to be, something Congress doesn't seem to feel like they have to do anymore. I mean, it's been a long time since sort of the grand bargain. And even though bargain technically fell apart, Republicans still got $80 billion worth of cuts in the budget. Where anybody's going to be willing to cut is, anybody's guess. And the deficit just keeps getting bigger, and the overall national debt keeps getting bigger. Sooner or later, that debt will catch up with us.
So here's the latest this morning. Lawmakers struggling to avert a government shutdown before Friday's midnight deadline. The measure expected to set a new March funding deadline, pushing the issue to Trump's second term. Henrietta Treyz of Veda Partners writing, investors should read into this bill that, contrary to the assertions of the incoming Trump administration, federal spending will not be cut next year. Henrietta joins us now for more. Henrietta, welcome to the programme, as always. Can we put a number on this for 2025? Just how big will that deficit actually be?
Well, sure. I'll put it into some context for you. The NDAA is going to increase federal spending by 1% over $884 billion. That's just one bill. And then the CR that they'll pass by the end of this week is going to increase federal spending by at least $100 billion as they try to just compensate for the hurricanes and typhoons and other disaster relief. So that's just to get us through March. We'll continue that spending pace for the rest of the year.
I thought we weren't supposed to be in this process the week before Christmas. Speaker Johnson said he wanted to make sure everything was over and there wasn't, this Christmas tree wish list of jamming whatever you can into a CR. What happened?
Emery, it's a perfect example of what we're going to get into next year. When you have a 0-seat margin in the House, you have to delay release of this politically sort of painful or toxic legislation that does the opposite of what you intended to do. So you get these last-minute pieces of legislation, hope that members will vote for it on, jet fumes as they're trying to get out of D.C. And that is a huge component of just getting this bill turned into law, is wait until the last minute. And I expect that we'll see that not just once, but twice next year, as Republicans have to negotiate with Democrats on a government funding bill into March 15th and beyond. And then also on the debt ceiling, which could either be in March or more realistically, probably in July, when we start hitting up against that deadline.
Is there any chance they put provisions in this upcoming CR about the debt ceiling, given the fact that this is game on January 1st?
Not this CR. I don't expect to see the debt ceiling attached to this CR. They can't do the debt ceiling politically until they absolutely have to. And I don't think negotiations with Democrats are going to bear fruit on that front. My big question is whether it's going to be addressed in the March 2025 CR or if they're going to keep it as a whole different package. Late last week, Senator Lindsey Graham, who's going to be the Budget Committee chairman, indicated that he will not be including the debt ceiling in a reconciliation bill, which means that Republicans are going to have to negotiate with Democrats. It's a politically toxic piece of legislation that will either suspend the debt ceiling for another year or two, and alternatively increase the debt ceiling by another $1.5 trillion just to get you a year of functionality.
These bills that we're talking about is just for the government to function. When are we going to see the lawmakers talk about some of the policies, given the fact that they had this sweep, in a reconciliation bill?
Yeah, that's happening right now behind the scenes, and they're trying to figure out if they're going to go with two pieces of legislation or just one. The Senate would like two bills, knowing and acknowledging that the tax bill is going to take all year to write. If you wait for just one piece of legislation that includes a massive $4.6 trillion deficit increasing tax bill, then you're probably going to need to effectively give Trump no legislative wins until December 2025. That's obviously politically missing an opportunity. And I think what incoming leader Thune is recognizing is that they could get a small reconciliation bill in the first half of the year that addresses the border, military spending, and immigration components. And that's going to spend anywhere between $20 and $200 billion. So that bill they would try to pass first. They're working behind the scenes now to pull that reconciliation package together. But to put this into some context, the House Republican Conference isn't even going to meet on this topic until January 4th. So it's going to be a while. It's going to take all of first quarter 2025 to write that if they get it done.
Henrietta, our bar is so low that we are hopeful that the members of Congress can get together and just keep the government open for another couple of months before they can reconsider whether or not to keep the government open. We were talking with Terry Haines about a real fundamental question about a vacuum of power in Washington, D.C. as a host of threats face off, whether it's drones, whether it's spying from China, whether it's some really unfortunate incidents that happened on an Army base over the weekend. What do you make of just how vast this vacuum of power is right now?
I mean, that really is stuff that the House and Senate are not equipped to handle quickly. They cannot pass legislation with any kind of speed. And as you're pointing out with the CR, they usually only do things under duress at the last minute. So that's really an arena for either a state government or the president to do whatever he's able to do under executive order. But it's just not what the House and Senate are equipped for.
One of the aspects of government that tends to bring comfort or fear, depending on your beliefs, is that there are a core group of people who don't focus on sort of the winds of politics, that are just keeping their nose to the grindstone and paying attention to what the threats are, to surveilling the skies. Are those people staying and doing those jobs? Are they leaving? Do we have a sense of whether that infrastructure is intact?
You know, those core competencies, those civil servants that are in the federal government are folks that have chosen to dedicate their life to this. And what I think is really notable and missed in the conversation around DOGE and cutting the employee workforce is that for the last 40 years, federal employee rates have been effectively flat, meaning this is not a situation where you have some growing corporation that has this boost of employee activity. This is a relatively stable 40-year norm for a federal government that has gotten much bigger in terms of its daily interactions, its legislation, responding to a pandemic, the Great Recession, the Affordable Care Act, the Chips and Sciences Act. You pass all these massive bills that should grow major departments like the Department of Commerce, for example, under Secretary Raimondo. When you're investing in infrastructure with $1.5 trillion, when you're investing in chips and sciences and doling out these massive grants across the country to grow batteries and semiconductor chips and all those plants for the emerging economy, you expect it to get bigger, but that's not the kind of bloat we see in the federal government. And those folks hopefully will stick around.
Henrietta, Lisa was using language that only comes to mind when you talk about drones, talking about surveillancing what's going on. Do you think in this new CR that we have coming up, there could be new regulatory rules regarding drones, given the fact that we've seen bipartisan criticism about what's going on right now in neighboring New Jersey?
I would be really surprised. Right now, they're really tied up over the Farm Bill and another aid package as we anticipate that Trump launches additional tariffs that China then responds to and hits farmers. As you know, there were 3 farmers bailouts in the first Trump term, and they're trying to sort of get ahead of the tariffs that are coming by providing them with a preemptory bailout package in this CR. So that's what the debate is about right now. I haven't seen it get sideways about drones, but obviously Senator Schumer, the current majority leader, is interested in the topic. So it's possible. But you mentioned that Christmas tree at the beginning. They're going to try to keep controversial stuff out of this to the extent possible, and they're already tripping over just over farm aid.
Are they lying to us about the drones? Henrietta, yes or no?
That's above my pay grade. I don't know.
Henrietta, Treyz there, Veda Partners. We'll let you go. It's good to see you. Thank you. We talked about this a few times already this morning. Option 1, they either know and they're not telling us, or option 2, they don't know and that's terrifying. Which one is it?
And which one do we prefer? Honestly, I hope it's that we're being gaslit. That's at this point, I hope that that's the case. But that does seem to be the reason why people are concerned.
Well, you don't really see on the weekend a number of officials from Homeland Security, FBI, come out and have to talk to reporters because of the uproar that we are seeing with these drones. The fact that a local airport had to be shut down. And then Mayorkas comes out and he says one reason for the increase in sightings that in September 2023, the FAA allowed nighttime drone flights. Well, why did the FAA allow that? Why?
There's a reason for the loss of trust, and you mentioned it earlier on this morning. The spy balloon of almost 2 years ago now wasn't a thing. Oh, it's a thing. We got to shoot it down.
Yeah, there have been a series of these. Maybe they're just Christmas drones, you know, Christmas lights.
Christmas drones.
Yeah.
Of course. What did the Chinese say that weather balloon was? A weather balloon.
A weather balloon.
Yes, of course. Not
there
a spy
you go.
balloon at all.
Climate balloon. Of course.
There we go. Up next on the programme, Will Vanloh of Quantum Capital Group on surging investment to power AI. I get the temptation to be bearish right now. I'm just glancing at Bramo as I say that. But it's been expensive to be bearish through this year. Equities at all-time highs, credit spreads are really tight. Bitcoin's on a 7-week run. Make it 8 weeks after this morning's advance.
Some people bought when mortgage rates were low. That's all I could say.
It's true. That was the call of the century. Barron's. I bring this up because Barron's went with embrace the bubble.
Yeah.
You see that over the weekend?
Well, yeah. I mean, this is basically what we hear from everybody. I mean, Brian Levitt was on, and he said, you know, I was the FOMO kind of guy. I was like, are you still FOMO? He's like, like you can't be. So everyone's in this Goldilocks time. Look, have I been so bearish? Have I been raising the prospect of Armageddon?
On a relative basis?
Sure.
Less so since the election. I'd say you're less bearish.
I mean,
since
look,
the election.
I think that there is a narrative that can be painted that things are going to look really ugly tomorrow, but it's the holiday season.
You're doing it just because Christmas is around the corner.
100%.
How generous of you. Equity futures right now, the S&P 500 advancing by 0.25%. On the Nasdaq 100, we're higher by almost 0.5% now, following a 4-week run for big cap tech in America. With your morning movers, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. Welcome back. Good to see you. The personification of activism is displayed in this stock this morning. Honeywell. Elliott took a $5 billion position in them early in the autumn. They wanted radical change, and bam, bam, bam. Here we go. Unlocking shareholder value. Read shakeup. Aerospace division. Potential separation, transformational changes. It basically means somebody's got a $5 billion stake. They want change. They want their payback. And that is what Elliott are extracting today. We need to understand the valuation around this aerospace business. Of course, this company took a $400 million downgrade on their sales. The free cash flow down by $500 million. So maybe activism has merit and value in this particular stock. Ford gets a downgrade from Jefferies. Interesting stuff. They're talking about $9 on the share. You've now got the most amount of sell ratings on Ford since 2009. Nearly went for 1999. The sell equivalent rating. One of the big decisions they're going to have to make, according to Jefferies, is this, Jonathan: resizing, if not exiting from Europe. So there's a lot of issues around that call. I take you to Capri. Take your mind back a couple of months ago. Bailed on this deal. It fell apart with Tapestry. It looks like they've appointed, well, we understand that they're talking to bankers about finding buyers for the two brands in the stable, Versace and Jimmy Choo. The question is, do they go as a one-stop shop, or is it separation and creating perhaps a little bit more value there? Jonathan.
Manus Cranny, thank you. Protect that affordable luxury. The objective of the US government.
That's all it was with the antitrust. Yeah. It was not just luxury, it was affordable luxury. I didn't even realize that was
affordable luxury. Is that luxury by definition? I'm not sure it is. Under surveillance this morning, Secretary of State Antony Blinken saying the US held direct talks with the Syrian rebel government. Blinken also holding out the prospect of sanctions relief as Syria's post-asset transition meets goals laid out by the United States.
This is going to be challenging because HTS is deemed a terrorist organization by the US government, a number of people. So how do you lift sanctions on HTS? At the same time, they're coming in with a little bit of a change of tune on how they would like to govern. And if they are going to govern and Assad is not there and there is this power vacuum, they would need sanctions relief for the idea of being able to make sure that fuel and food are able to get into the country. Very challenging time. Luckily for this administration, though, they'll be handing off this problem to someone else.
Just to jump in, what is it about Syria and sanctions relief with this administration? Wasn't there a report suggesting that they were willing, or at least exploring, removing sanctions on Assad before this even happened?
So I have some reporting on this, but came weeks after, and shout out to Reuters, who got this early in December, that they were saying that the Biden administration and the UAE were in talks and discussion of potentially lifting sanctions on Assad. And the reason for this would be to try to push Iran back, to isolate Iran. If you lift some sanctions on Assad, maybe you bring him more into the fray of the Arab world in the Middle East and push back on Iran. What spells out for me, though, the second I read this report and then you saw the fall of Assad, was this administration, if they were considering even discussions of lifting sanctions on Assad, meant they had no clue that that government was so weak that he was about to fall.
They've missed a lot of things in the Middle East over the last few years, that's for sure. Let's turn to our next story. Homeland Security Secretary Alejandro Mayorkas saying that drone sightings, mostly concentrated in New Jersey, don't pose any public or national security threat. Mayorkas saying increased sightings could be the result of 2023 FAA rules allowing nighttime drone flights.
Why did they allow nighttime drone flights? I mean, that's another question. This, though, coming from a number of different sources. OK, we had two scenarios. One, they don't know, and that's scary. Two, they're gaslighting us. They do know, and there's something else. Third, what if those drones are looking for something, say like radioactive material or something specific that could be a threat? You know, I mean, there was the prospect of aliens, but I don't believe that. I think that there is this question about, is there something else? And I think that that really goes to this crux of a vacuum of power right now, a vacuum of leadership that raises some concerns for a lot of people.
If you have no policy in Congress when it comes to things like drones, everyday people can buy them, go out. You and I can go out and maybe buy a drone. If it's less than half a pound, we don't even have to register it. or it can go into the hands of adversaries. And that is the concern that is happening right now, especially when they're over critical infrastructure or near where airplanes are taking off and landing.
I was once in Florida, and there was this group of guys that had this beautiful new drone. And they came over, and they set it up, and everyone gathered around to watch it. And they made it go, and it promptly got stuck in a tree. They spent the rest of the afternoon trying to get it out. So
that's your experience of drones.
That's my experience with drones.
Gaslighting. I think we need to talk about how much the general public in this country has been gaslit by this administration over the last several years. You talked about the article, I think, of the Journal earlier on this morning, on the border, on the president's mental acuity, on issue after issue. This general public, I think, feels like they've been gaslit by the Biden administration on several issues over the last several years.
And when it comes to the drone, the issue that many feel the most gaslit by, similar to this, has to be the Chinese spy balloon. They were told it's not a big deal, and then it was told, actually, we are concerned, and we're going to not actually have our top diplomat go to Beijing because of it. This is how the editorial board at the Wall Street Journal puts it. The Biden administration has squandered its credibility to the point that it's rational not to believe what it says. And that is why people, including Democratic lawmakers and governors, are saying, actually, we want more information on these drones.
Another 1 month left. Let's turn to Apple, reportedly working on a foldable iPad for a release in 2028. Sources telling Bloomberg's Mark Gurman. Designers are developing something like a giant iPad that unfolds into the size of 2 iPad Pros side by side. Apple also exploring, reportedly, the idea of a foldable iPhone as well. So they're finally making a move.
Well, yeah, but here's the obstacle. Get rid of the crease. They can't get rid of the crease. No. But but this is the whole thing, is that they might get rid of the crease. And this is sort of Apple's playbook, is do it late, but do it better. And so if they can get rid of the crease, that's sort of the holy grail.
So the prototype of this device, quotes, have a nearly invisible crease. If you don't have the crease, then yeah, why not? Maybe this is something worth buying. I don't know why everything needs to be foldable, though.
So we're waiting for the foldable phone before upgrading now.
Oh, God, really?
So the cycle is further down the road.
Okay, this is for you, for the Pharaoh
Well, actually, I think it's for people who do not carry handbags. I know Jonathan doesn't, because if you don't have a handbag...
Thanks for clarifying.
You should get some affordable ones.
You need a phone if you want a bigger screen, but it has to be able to fit into your pocket.
I was in the market for a Coach handbag, and I'm pleased that the president's protected them. That was very important to me. Going into 2025. Let's talk about the rise of AI fueling energy demand. Goldman Sachs estimating US data centers will use 8% of total power in a country by 2030, or 3 times the level from 2022. Will Vanloh is the CEO of Quantum Capital Group, one of the largest private capital providers to the global energy industry. And Will joins us now. Will, good morning.
Good morning.
It's good to see you, sir. The incoming president wants to unlock energy in America. Drill, baby, drill is something we heard from him repeatedly on the campaign trail. How difficult is that actually going to be?
Well, first of all, thank you for having me on this morning. It's going to be very difficult. And in terms of oil and gas production, oil in particular, we have really developed most of the shale resource plays. And other than the Permian, they're all either peaking and rolling into decline, or they will soon. And I think the Permian, maybe we can get another 1 million or 2 million barrels a day out of it. So we produce about 13.5 million barrels a day right now. So maybe it gets up to 14.5 or 15.5. But that would really be the physical limitations of the Permian.
Given the fact that there seems to be a long runway for anything in terms of infrastructure in the energy space, what could changes in the Trump policies next year actually do fundamentally to shift the investing landscape, to shift sort of the energy landscape from your perspective?
Right. Well, I think the biggest thing is lifting this LNG pause that got put on last year. You know, there were tens of billions of dollars of investment that were slated to go into the next phase of LNG build out. That's critical for our allies. That's critical for America projecting its power throughout the world to be able to export that energy. So I think that's the biggest thing that he could do immediately. And he said, you know, first day in office, that's something very likely may do. But I think other than that, permitting reform is the biggest thing that we really need. And that's not only for oil and gas, but that's also for transmission. I mean, that's the big, as the wind and solar build out continues. The biggest bottleneck is transmission. So I think having regulatory kind of relief in terms of how long it takes to get these power lines permitted, permitting midstream pipelines so we can get that gas. America has a lot of natural gas. We have a lot more natural gas than we do oil. And so we've got to be able to build the critical infrastructure to get that power and that gas around the country.
What's been fascinating to so many people is that there is a dissonance right now to all the discussions around artificial intelligence, the energy that's required to power that, and then just how long the process is to build it out from an infrastructure process, and then the fact that policies tend to ping pong and they change quite considerably. How do you get around that when you're investing to try to cater to what seems like a really big opportunity but has these major pitfalls?
Yeah, I mean, look, it's AI, a typical AI query, generative AI query, takes 10 times the amount of power that a regular Google search takes, right? And so when you look at, you mentioned that power demand will literally triple for data centers over the next kind of 5 to 6 years. That's a massive amount of power. You know, a data center, say a 1 gigawatt gas turbine that fires a data center could power 800,000 homes. So you think about that, a data center demand for power is going to grow about 50 gigawatts over the next 6 years. That's enough power. We're going to have to install enough power to power 40 million homes. That's a lot of power.
Wow, absolutely. When John started off the conversation, they're talking about drill, baby, drill.
Yeah.
I can't help but think that President Trump was elected, and then a few weeks later, Chevron is saying, actually, we're going to pull back on the Permian. Do you see more U.S. oil producers pulling back on drilling? Because actually, the oil right now, price point is just not advantageous.
That's correct. So you look at where prices are today, the inventory that's left that's economic at these levels, and that's why I say that you got to be very careful about projecting how much production U.S. can actually grow. And so at these prices, no, I don't see anybody drilling more.
Do you think then the Trump administration would be more willing to either accept what the Biden administration might do on their way out or do it themselves, which is to maybe start to hold back on Russian oil, saying instead of this price cap, we're actually going to sanction oil outright, really hurt Putin. At the same time, if the prices go up, that actually might be better for U.S. drillers.
Yeah, I mean, it's difficult. I mean, there has been sanctions in place, arguably not very good ones. And so I do think that's clearly, it's been rumored to be talked about. How effective it'll be, I don't know. But I will say I do think that President Trump is very focused on keeping energy prices low for the American consumer, and sanctioning Russian oil would have just the opposite effect of that.
The other thing you mentioned, of course, is gas and how the U.S. has so much natural gas, and you think we're going to see executive orders when it comes to these LNG permits. Do you see deals growing, say, for the United States and Europe, because they're looking for some sort of bipartisan wedge into acquiescing themselves to the Trump administration?
Well, Europe is still buying a lot of gas from Russia. It's not talked about very much, but they have to, okay? And so that's absolutely why we need American LNG to be expanded significantly. We have the gas to supply to our allies in Europe. And so, you know, I think that's going to be a very critical part of Trump's energy policy. And it's something that really needs to happen.
In the meantime, given that all these policies are sort of question marks right now, how much are you going to the sure thing, which is tech companies themselves, and working directly with them in order to build out energy? Because they need it, and they need some certainty, and you could probably provide that with the pool of capital that you have.
Yeah, so I think a couple things are going to happen. The problem with all the growth in AI demand for electricity is it still takes 4 to 5 years to go get a new gas-fired power plant built. And so we have to look at the existing asset base in the U.S. today. If you look at the roughly 200 gas turbines that are installed generating power that are greater than 500 megawatts, those run at about a 55-56% capacity factor, okay? So there's a lot of capacity left in existing assets. It's just, are the regulators going to allow the tech companies to take that excess power? Because that excess power is needed whenever it gets really cold or gets really hot and demand surges. And that's going to be the real kind of tug and pull, is we have it. It's going to take a lot longer to build out the new power plants. But how is that going to play out between the consumer on one hand and the tech companies on the other hand?
In 5 to 10 years, how different is the backdrop going to look for big energy in the United States at a time where big oil has been sort of self-constrained in a number of different ways from their investing programs, and you have upstarts like not only yourself, but a whole host of private investors who are trying to really get in alongside big tech?
Yeah. So I think there's a lot of capital that's been formed. You've heard about these huge partnerships over the last couple of months that are all kind of around data centers and supplying that power for data centers. If you think about it, if you spend $1 billion on power for a data center, you're going to spend about $10 billion on the data center itself, another $20 billion on chips. So the power component's only about a little over 3% of the total cost of a data center. So I think there's going to be clearly the big tech companies are going to have to partner with both private and public companies to get that power. But the truth is most of the power is controlled by big utilities, regulated utilities. And so I do think you'll see a lot more private companies coming into that space to partner with the big tech companies.
Americans do not want European energy prices, that's for sure. I'm wondering how much pressure there will be on providers to make coal great again. How pragmatic do you think politicians, leaders in America are going to be on that issue?
Well, you know, if you look at the United States, we have retired a lot of our coal plants over the last couple of decades. Europe's retired even more. Just a few months ago, the UK retired their last remaining coal plant, which is an extraordinary statistic. They've had it over 150 years.
It's amazing. And I see the government leaders celebrate it all the time. And then my mum calls me and tells me what her electricity bill was.
That's right.
What her fuel bill was. And it's astronomical.
And what you got to appreciate is in every other part of the world, China uses more coal than they've ever. We use more coal today in the world than we've ever used before, despite all the drumbeat about how we've massively reduced the reliance on it. We have in the West. The rest of the world, India, China, you know, it's exploding. And so that's it. It's not really matter. It doesn't matter where it's burned. There's one atmosphere, right? And that's the other thing we have to appreciate. So coal use is going to continue to go up. I don't think it will necessarily in the U.S. It will in Europe whenever they get really cold or really hot, and that's the only fuel they have. But in Asia in particular, you're going to continue to see massive use of coal. Why? Because that's the fuel that they actually have. It's about energy security. And that China uses EVs, not because they love the environment, but because they can burn coal to power those EVs and not have to import gasoline.
Amazing. Will, it's good to see you. Thank
Always
you,
good
sir.
to see you all.
Will Vanloh of Quantum Capital Group. Amazing, of course, for all the wrong reasons. With an update on stories elsewhere this morning, here's your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. SoftBank CEO Masayoshi Son is expected to announce this morning that he'll invest $100 billion in the U.S. over 4 years. A person familiar says that Son will make the announcement at a press conference with President-elect Trump. It will also include a promise of creating 100,000 jobs focused on AI and related infrastructure. The pending Skydance Paramount merger is facing more critics. In an FCC filing, Fuse Media said that the combined entity would have more power to prioritize its own content over independent programmers like Fuse. Echoing concerns raised by manager Mario Gabelli, Fuse also argued that Sherry Redstone would be overpaid in the deal. Disney's Moana 2 topped the North American box office for a third consecutive week. According to ComScore, the sequel grossed $337.5 million in North America. In second place, Universal Pictures' Wicked earned $22.5 million on its fourth weekend. Rounding out the top three, Sony's superhero film Kraven the Hunter debuted to a $11 million opening. And that is your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the looming tariff threat.
The big question and the big opportunity and the big unintended consequence of tariffs will be passing this cost on to consumers, which may yield inflation. So we'll see.
That conversation up next. Equity futures right now in the S&P positive by 0.25%. Under surveillance this morning, the looming tariff threat.
The big question and the big opportunity and the big unintended consequence of tariffs will be passing this cost on to consumers, which may yield inflation. So we'll see. We think as much as 50 to 90% will need to be passed on to consumers, and it's something to watch.
So here's the latest this morning. Retailers and consumers bracing for President-elect Donald Trump's proposed tariffs. Simeon Gutman of Morgan Stanley writing US-centric companies are better positioned near-term sentiment-wise, given recent dollar strength and tariff risks for multinationals. Simeon joins us now for more. Simeon, it's good to see you. The note that you've put out, a private label tipping point. Why do you think private label is going to win when we embrace and brace for what could come down the road in 2025?
Thanks for having me on a Monday to talk private label. Think about what's happened in the last few years. We've had rampant inflation. Consumers are paying 30% more for food. All the retailers, food retailers, discount retailers, are introducing new products, private label products. Private label used to be synonymous with lower price. Now it's becoming higher quality. They're fighting back the price increases to give value to their consumers, and they're innovating like never before. The quality has taken a quantum leap, and that's what we're seeing starting to shift.
Who's winning this?
There's a few very large winners. Costco in Kirkland, they've already been a winner. That's one of the largest brands in the world, and they go across multiple categories. If you think about some of the individual retailers, Trader Joe's and Aldi, those are private label houses. They've taught the customer that this product is good quality, it's reliable, it's trustworthy. On the come, it's still Walmart introducing new products, Target, and some of the large grocers like Kroger and Albertsons.
Are they commandeering the supply chains with their private labels?
They're working to. I mean, we've seen a few rifts in the private label world. Look at what Costco did with their rotisserie chicken. They couldn't get enough supply, so if you can't buy them from someone, you build a plant and you run it. And this way you can keep the price, the famous $5.99 rotisserie chicken.
The fact that you think there's going to be a super cycle, the latest boost to that, is that because of multinationals are really going to suffer under potentially a Trump administration with tariffs?
A little bit. I mean, we could go on that angle. Now, a lot of food, shelf-stable food, is still made in this country, and a lot of refrigerated and frozen food made in this country. But it's all about price increases and finding ways to deliver more value to the consumer. But we're seeing this shift where these mega platforms, Walmarts and Amazons and Costco's, they're garnering a much bigger percentage of overall consumer spend.
Are we misunderstanding the story when we say that people are down trading to Walmart? That maybe it's that Walmart and Costco are actually offering better products and catering to higher income customers? Is that really what's going on?
That's exactly right. And you could have said it, you couldn't have said it better than what you just said. Think about Aldi. Aldi is coming up in social influencer circles about the quality of their organic private label. Aldi is a channel, in theory, for lower income or lower value shoppers, but yet they're getting the credit for high quality private label. That's the shift that's changing. That's what these retailers are slowly accommodating to.
So the Walmart signal that people used to look for, that when they did well, everybody else did terribly, and that meant the economy was tanking, has that been ultimately broken?
Big time. So we call this thing the funnel, and we look at how much incremental share is Walmart taking of overall retail spending. That number is roughly, call it 10 cents on the dollar. Amazon's a whopping 30 cents on the dollar. So together, they're taking 40 cents of every new dollar. Walmart's doing that. It's not because their core customer is suddenly wealthier. It's because they're getting more share of a middle and upper income customer naturally.
Yep. This is the argument that Lisa's made repeatedly over the last few months. Is that why Simeon's here, to validate your views on
Thank you.
on
I
retail?
appreciate that. It was really well done.
Hey, Simeon, thank you. I appreciate it. We've just got to fix that line at Trader Joe's.
Yeah.
You know, on the weekend.
Oh,
But they're quick. They move quick.
It doesn't
Just sort of
matter.
goes
It just makes you
round
feel
and
like you're
round.
like, what are you doing with your life?
Hate it.
Yeah.
The Fed's more than likely to go through neutral, to go from a restrictive stance on policy to a stimulative one in the coming year.
With the Fed, a big piece of the caution is they are, to their core, data-driven in their monetary policy. And we know data are messy.
The market looks very convinced that a cut is coming.
Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
Starting in the first half of next year, you could see the Fed, not explicitly, but implicitly start to signal pauses.
This is Bloomberg Surveillance with Jonathan Berro, Lisa Abramowitz, and Anne-Marie Hordern.
I missed you too. Thank you for the warm welcome back. The third hour of Bloomberg Surveillance starts right now. That was to you. You said you missed me, and it took me a while to get back to you.
It took you 2 hours to get back.
After 2 hours,
okay.
I missed you.
Well, I missed you too. I'm really glad you're back.
Equity futures up by about 0.2% on the S&P. On the Nasdaq 100 up by 0.4. A 4-week run on the Nasdaq 100. The S&P 500, the biggest weekly loss in about a month. Small caps suffering for 2 weeks. I think we've got to sit on this, Lisa, and just talk about what's been going on And what hasn't happened since the election, what we thought would happen, what a lot of people came on the show said would happen was that the equity market rally would broaden out. The small caps was a place you wanted to be, and for November it certainly was. Big move higher. Since then, though, just over the last couple of weeks, big tech starting to reassert itself. Small caps starting to struggle. The trades that people thought would work into year-end and beyond starting to stumble.
The big reason why has to do with the bond market, basically. You saw yields going higher. Initially, they went lower. Initially, people said, actually, Trump administration's agenda won't necessarily be as inflationary as we thought. Okay, maybe we're going to see lower yields. And then that all started to reverse. And I think that was the big shift where suddenly people said, wait a second, the inflation might be a lot stickier. That might be reflected by the Fed, and that might undermine some of the story for the small caps.
Last week happened, 24 basis point move on a 10-year, around 26 basis points higher on a 30-year. This morning, across the curve, yields come in by a couple of basis points. We're down about 2 or 3 on a 10-year. We're down 2 on 30s. All of that going into retail sales tomorrow morning, and the big one on Wednesday, the Federal Reserve. Overwhelmingly, the consensus is a cut and then a skip. Will that skip turn into a pause?
At a time when really there are so many uncertainties, how much are they actually going to give us that information, and how much are they going to give us a framework of how they're going to be judging policy? To me, I want to understand what their scenario analysis is at a time where they say they don't want to make projections, they don't want to make assumptions. Okay, then what are your models? How do you even begin to try to understand this at a time when a lot of the previous ones seem to be kind of broken?
Was what Bill Dudley had to say last week. This idea that they should be starting to assume some things, because the financial markets as well have baked a lot of this in. Two things come to mind. Will he talk at all about what extending TCJA could mean? Those are the tax cuts, and also potentially what tariffs can mean. Oxford Economics out with research today talking about how actually businesses in their survey are starting to get a lot more nervous about what the tariffs might look like and how it might impact their bottom line next year.
The problem is you've got to make more than one assumption. You've got to make an assumption on what policy will look like. You've got to make another assumption on what that policy will do to growth and inflation. And there's a real debate, I think, on Wall Street about that. We caught up with Steve Chiavarone of Federated earlier on this morning, and Steve made the point that he thinks people are overestimating the inflationary outcome off the back of some of these policies and underestimating what could happen to growth.
And a lot of that comes down to people don't understand, or don't agree, I would say, on exactly where we are now and how inflationary the moment we're in now is. You look at, say, the inflationary read last week. Some people say, it's just because eggs got expensive. Other people say, look at housing market. Prices are coming down. And other people are saying, look, there still is tightness in the labor market. You could see that from a higher, just a headline number on the jobs figures. And you have to look at that as well as some of the investment and go to that instead.
Chairman Powell, the main event later this week. Equity futures right now on the S&P up around about 0.2%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine, Saxon Woods as markets brace for the final Fed decision of 2024. We'll speak to Tom Narayan of RBC with Tesla sitting near all-time highs, and Mona Mahajan of Edward Jones on why animal spirits are only just awakening. We begin this hour with stocks higher and investors looking ahead to Wednesday's Fed decision. Sarah Hunt of Alpine, Saxon Woods looking to next year, writing sticky inflation and some unknowns in the labour market given the last few months has already tempered market expectations for rate cuts after the December meeting. How the data shakes out in the beginning of the year may be a driver for markets absent a clear path. Sarah joins us now for more. Sarah, good morning.
Good morning. Good to be here.
Let's reflect on the last 12 months before we talk about the next 12 months. I remember coming into 2024, it was 6 or 7 rate cuts. Then inflation data happened in the first quarter. Then the first quarter's inflation data was a bit of a head fake. Then the summer's labour market data happened. And then the labour market data of the summer was also a bit of a head fake. I think we've had 4 different versions of a different story through 24. Is 25 going to be any different?
I don't really think so, because I think the reason that you had all those different narratives in 2024 was because we make all these big assumptions. We chart a linear path, and then the data says, no, we're not going to be that linear. I don't think that that's going to change. I think that you have seen cross currents both up and down, and I think that there are some things to be concerned about on a variety of different fronts. So I just think that the lack of a clear path is probably going to be continuing.
That screams retain optionality at the Federal Reserve. How do they go about doing that this Wednesday?
It's an interesting question, and I think that the way that they present it is going to be important. But I think that whether you call it a skip or a pause, I think that the recent inflation data, the baked-inness of December, probably means we get 25 basis points this week, and it probably means we set ourselves up to say we're going to look at it meeting by meeting. However they want to phrase it, I think it's going to give them room to say maybe we need to pause or maybe we need to skip. But I don't think that anybody wants to talk about reversing course yet. So I think that, it's important to say this is the direction we're heading in, but we need to make sure that we're not going too fast so that the data doesn't undercut it.
So far, we've seen the market bake in the expectation for a skip. We've seen this idea that the market expects a slower pace of rate cuts for the Federal Reserve. Have equities fully understood this in their valuation?
I think equities are going to go. Now they're just going to keep cutting them. And I think that's where equities are right now. But baking in a skip, to John's point earlier, we've baked in so many things that have been unbaked in the cake later that I don't know that what that actually, how meaningful that becomes, that expectation, unless it's right before and you change it like 24 hours.
Okay, I guess that the other way of asking this is, how different are the views right now of the economy and markets between the bond market and the equity market?
I think they're pretty different. I think the bond market is getting worried about the fiscal picture. I think the bond market is getting worried about the concerns that we have about all of a sudden we're starting to get into a fiscal fight right before, hopefully not a physical one, right before we get into the beginning of a new administration, right? You've got all this stuff that we punted in September that we are going to have to contend with. And the equity markets are going, hey, growth is pretty good. We've got these great new technologies coming out. I think that the quantum computing chip by Google was a big deal for the markets to have another thing to hang their hats on in terms of the growth that's going forward, right? The AI story is playing out. The infrastructure was being built. Now people are using it. It's starting to save them money. And so we need something new. So that adds a new layer. And equity markets are looking at that and going, great, things aren't that bad otherwise. And bond markets are going, oh, there's all these things that I could worry about, which is typical of those two splits, right?
What else is new?
So I think it's a little bit different.
So a month ago, the rally was going to broaden. A month later, it's not at all. Breadth is negative. The Nasdaq's still ripping. What gives? What's behind that?
I hate to say this because I want to see the market broaden, but it's almost like it's Europe's year, right? It's not. The equity markets are not broadening out, and every time they do, something scares them because that scaringness, that's about growth, and it's about growth on the smaller side. It's not about the big tech guys growing. It's about, is the economy going to be okay? Do we get growth? And are rates going to come down? As rates were ticking up, I think that trade reversed. Do I think that it will broaden out if the economy is good? Yes, it should, but it does have a lot of stops and starts.
Do we keep getting squeezed into fewer and fewer things as investors? Are you seeing any signs of that?
I think we are. I mean, I think that's where the big tech names, when they start to re-rally again, everybody kind of has a little bit of relief because everyone's still in it. No one got out and said, I'm going to switch wholeheartedly to this. They just said, I'm going to up some exposure here because that's going to make some sense as we go down the road. But no one's selling off all their big tech names.
We talked to you a couple of months ago about why you were bullish on energy. And I want to go back to that because, to John's point, a broadening out in themes at a time when everyone was hoping that we could chase the new theme. That was something that Mike Wilson talked about. How much are we just in a sort of holding pattern right now, where people are still debating what the biggest offsides risk could be to hedge against? In other words, the idea of oil being an inflation hedge, the idea of bonds being some sort of downgrade to growth threat. How much are we still in this question mark around which really is the biggest threat?
I think we are, and I think that, I mean, if you want to talk about where markets are differing, the commodity markets are going, no, growth isn't really very good. The commodity markets are telling you that there's not an expectation that there's going to be bigger demand, right? You've seen retail sales out of China this morning that weren't that great. There's a global issue on oil, and whatever's going on in the Middle East, no matter how fractious it becomes, doesn't seem to have a big effect on the energy markets. And I think that that's one of those quiet things that if it becomes a problem, becomes a very big problem very quickly. But I've been perennially bullish and perennially wrong on energy, because even though I think that the infrastructure is important and has value, and you have seen a re-rating in those stocks, it's still not getting what I think is the respect it deserves. But that's very, very on the margin. The minute people think growth is slowing down, they're like, let's sell this whole area. So I think it's hard to see where those biggest problems are, but there's a fight right now in different sectors about what's actually going to happen. And the technology sector is going one way, and a lot of other sectors are going the other way.
When it comes to energy, though, the fact of the matter is, and the retail sales out of China, it's just a Chinese demand issue. It's because China is slowing. So doesn't that basically just signal that we are going into more of this tripolar world, as Jay Pawlowski would say?
Well, I think that yes, there's an issue internally, but there's a big driver there, right? Not just for their own goods and services, which they are trying to inflate. They'd rather see more Chinese goods and services be consumed in China. But there's also, I mean, there's a big commodity piece to that, too, that when things are slower there's less demand globally for commodities. So I think I think we are getting into more of a polarity that as opposed to a whole continuum. And you can look at Europe on the lower end of that right now, right, too? So I think that is important as well. But it's also, I mean, we're just looking to see the excitement in one area versus the non-excitement in others. And I think that's right now what the market is struggling with. And that's why the sector disparity is coming back.
What are you so worried about for next year in terms of the policy questions?
Oh, I'm worried about a lot of things for next year. I think the biggest problem really is the fiscal situation, right? So we have had, post the financial crisis, when you took interest rates to negative or zero, people got very comfortable spending a lot more money than we have. And now all of a sudden, there's a part of the budget that is now interest expense. And that hadn't been a problem for a long time. So we're talking about trying to be more efficient in cutting government. We couldn't agree on anything. And now we have some other expense that we have to pay.
It's a big part of the budget.
It's a big part of the budget. So I think that if I'm concerned about something of how that works, it's how that impacts policy decisions and what people are able to do. And I think that right now the market's baking in some things that they think that it thinks is very positive. But I also think that there may be a delay in some of that legislation that people are not counting on because of the fiscal situation.
You've talked about how there's a divergence in markets and how it's being expressed in a number of different ways, about how people are leading into the growth story of tech and not necessarily worried about some sort of surge in inflation or the idea of some sort of dramatic downturn. Which do you agree with? I mean, are you leaning into the bubble, as John was mentioning, or do you just sort of play the contrarian wagers about either an increase in inflation or a fall off in growth?
So personally, it depends on the day, right? But professionally, you have to look at this and go, okay, if I think I want to make sure that my portfolios are managed in a way that I'm comfortable with under a variety of scenarios. That's our job, right? Is to look at the probability scenarios and go, am I comfortable with where we are? So you want to make sure that you don't get out of that tech entirely. You want to make sure that the valuations on the companies that you're holding are reasonable, because one of the things that you can be concerned about is just valuation multiples, right? Because all of a sudden, are we re-rating forever to these higher levels? Or is at some point, I don't know that we're coming back to what you considered a traditional level for PEs for pick the sector, but I think that we're pretty elevated in some places that are high enough that you could be concerned. So you want to make sure that you are looking at those probabilities and saying, I'm comfortable under this scenario and that scenario. So I think that you have to be able to hold both in your forward-looking thought process. Otherwise, it becomes difficult to invest.
Just before you go, top pick for next year. What is it?
Oh, that's a tough one. I would say I still think that the energy infrastructure is going to have a place for investors, and it's cheap right now, and you've got good yields, right? So look at pipelines. Look at companies that play into LNG. Look at companies that play into some of the things that are split, but also some of the things that continue to have traditional hydrocarbons.
Sarah, appreciate your time. It's good to see you. Thank you. Sarah Hunt there of Alpine. Saxon Woods. Equity futures this morning, positive across the S&P 500 and the Nasdaq, with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Volkswagen's talks with labor leaders entered their 5th round of talks today. The two sides are still deadlocked on how to cut costs to make the brand more competitive. 2 days of negotiations have been planned, but if there's no breakthrough, the union will hold a vote at the end of this week for 24-hour walkouts in January. In a statement this morning, Honeywell says it's weighing a possible separation of its aerospace business, along with other strategic options. Last month, Elliott Investment Management called for a breakup of the industrial group. Elliott welcomed this review, saying Honeywell is on the right course. Last month, the activist investor revealed a more than $5 billion position in Honeywell. Starbucks is boosting paid parental leave for in-store workers. The company announced birth parents will receive 18 weeks of paid leave at 100% of their average pay. That starts in March. A parent who doesn't give birth will get 12 weeks. Previously, the company offered retail workers 6 weeks of paid parental leave and as much as 12 weeks of unpaid leave. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the morning calls, plus Tom Narayan of RBC as Tesla hits a record high. That conversation is just around the corner from New York. This is Bloomberg. Counting you down to the opening bell, 1 hour and about 13 minutes away. Equity futures on the S&P 500 doing OK, up 0.25%, and a rally returning to the bond market. Yields are lower by 3 basis points on a 10-year, 436.52. Let's get you some morning calls. First up, Barclays raising its price target on Broadcom to 205, saying its AI story remains intact despite a near-term transition. That stock is up by 2.8%. Your second call from Jefferies, downgrading Ford to underperform, noting inventory concerns and looming decisions about its European presence. That stock is down by 3.5%. And finally, Wedbush raising its price target on Tesla to $515, saying Trump's White House is a total game changer for the EV maker. That stock is up again this morning by about 0.9%. Let's stick with Tesla, the EV maker surging over 70% since President-elect Donald Trump won the election, hitting another record high in Friday's session. Joining us now to discuss is Tom Narayan of RBC, who has an outperform rating and 313 price target on shares of Tesla. Dan Ives making you look bearish, Tom. I'm sure that wasn't the objective. Tom, talk to me about what you think we're still underestimating about what we might see from Tesla in the years ahead.
Yeah, I think there's a couple of things happening. One is you'll get your affordable car at the beginning of next year, the sub $30,000 car. A lot of folks think that it could be the same aesthetic as a Cybercab, which I don't know about you, I think it looks kind of cool. And what if that has FSD version 12.5, even 13 on it? You know, I'm marketing in Europe this week, and a lot of folks are asking, sub $30,000 car with FSD, why buy any other car? So there's some catalysts there. And then obviously, if they get unsupervised FSD approved, I mean, upside is tremendous. So, I mean, you could do the math on robotaxis and get to like $10 trillion of total global market and have them get a small share of it and justify, you know, a much bigger price target. I'm not doing that just yet.
Sure.
But the upside potential is significant.
The outlook for them seems to be so much better than some of the legacy players at the moment, Tom. They're at an all-time high. Ford is down this morning. I want to share that note from Jefferies with you. Downgrading Ford to underperform, noting inventory concerns and looming decisions about its European presence. You're in Europe, I believe, at the moment, Tom. What are you learning about what's happening there? What are these US players doing in a market where we've seen downgrade after downgrade from European players?
Yeah, it's interesting. The best place to come to learn about what's happening, especially in Germany, is Frankfurt, and to talk to the investors who really are more plugged in than any of us are. And I will say there's some green shoots happening. I think because politically the possibility of more right-wing politics, especially in Germany, winning, could mean actually that the CO2 regulatory cliff next year might actually get delayed after all. So we're hearing more positive news there. Now, it's not all names are treated equally. The one name we're hearing the most that could be benefiting the most from different fundamentals and secular trends is BMW, actually. That one's getting a lot of interest. So the main kind of phrase I heard was not like getting bullish, but less negative. So that's kind of what I would say about Europe.
That's incredible. And I think a lot of people will cheer less negative at this point, especially from some of the European auto manufacturers. I want to put the stories together, though. The idea of we're talking about the optimism around Tesla and some of the investments. And then you talk about this question around Ford and getting rid of legacy aspects in Europe and trying to shore up some of their profitability. How do some of the legacy companies, whether it's Ford, whether it's Volkswagen, both invest in the future, right, which might be FSD, full self-driving, as well as certain innovations, while preserving their current sphere, right? I mean, has there been some hack that's been established for any of them that seems promising?
Yeah, I mean, the one that sticks out is GM, right? Look what they've done, right? They took a big impairment charge in China, and all indications are they're evaluating that business. You know what's going on there. They sold the one of their battery plant JVs to LG, and then obviously the big news, right? They came out of robotaxi, but now they're going full steam ahead into Super Cruise, their FSD type competitor. So it seems like what the legacy OEMs could do is pivot a little, right? If you're going in all these different directions, let's retrench and put our money into what people really want. I think there's a big push for Level 2 Plus, what Tesla FSD does. I was at a Mobileye event recently, or last week, and they're saying they're getting a lot of interest from legacy OEMs who want to use their product, because if Tesla has this FSD product and other OEMs don't, they need to keep up. So that one seems to be where investments are, and maybe you can pull away from doing some of the other ones.
Tom, that was where I was kind of going, was this question of partnering with other outside firms that are coming up with new technologies, this idea that maybe it doesn't make economic sense for some of these companies to do it themselves. How much is that the path ahead, and which are some of those companies that are really benefiting the most?
Yeah, that seems to be really where, I mean, look at what happened with Volkswagen, right? They went with Rivian for software-defined vehicles. They went with Mobileye for this FSD-like software. That's the one that everyone's kind of looking at, that potentially Mobileye could be a big beneficiary if companies want a level 2+ offering. Yeah, and then some of the suppliers like an Aptiv, which does some of the wiring for electrification and some ADAS. Magna's another supplier that does some ADAS. So, it makes sense that instead of putting your hard-earned cash, that if you're concerned especially on higher dealer inventories or et cetera, maybe it makes more sense to outsource that instead of trying to vertically integrate. So yeah, there's a number of suppliers that could benefit, and you have to look at the secular trends. Electrification's one of them. That's kind of slowing a little, but ADAS, that's the one. Assisted driving, level 2+. That could be the place. I think we're going to see some more investments.
Tom, when it comes to legacy auto companies, last week we heard from Mary Barra speaking to Axios, and she said a federal regulatory framework for self-driving cars, something that Elon Musk is pushing the incoming Trump administration to do, would be better than state-by-state patchwork of regulations. While they may be jealous of the first buddy and his proximity to power, will he lift all boats when it comes to potentially some of his influence on the incoming policies?
Yeah, I mean, I do have to stress, though, that while getting federal framework on self-driving is definitely a positive, GM wanted to get that Origin car that doesn't have steering wheels and pedals and had to scrap it because it was getting difficulty. Now it seems like it could. Let's not forget, robotaxis are a very local business model, right? So states, municipalities have to approve. So while it is at a very high level positive to have the first buddy, let's say, let's not forget, these guys have to get approval. Maybe Tesla rolls out in Austin, a friendly city, but what happens in California, right? There's some friction there. Will they have to put LiDAR in those vehicles? So the federal friendliness doesn't necessarily mean federal deregulation, approval of robotaxis. It just means at a high level, probably the sentiment is getting more positive.
Hey, Tom, enjoy London. It's got to catch up. Tom Narayan there of RBC on the European auto market. Just to begin that conversation, BMW, VW down by more than 20% in 2024. Stellantis is down by close to 40%. It's been brutal for many of these names.
Yeah, and it's sounding less negative because potentially there could be a removal of some of the regulations, at
Small
least in the near term. This bar
Really
is
low.
getting lower and lower, which is the reason why some people are getting bullish.
It doesn't take a lot.
That's
It doesn't take a
evidently
lot
what's
to
going
change
on.
things. We talked about this earlier this morning. Very little needs to go right to push this market in a different direction. Up next on the programme, we'll catch up with Lydia Boussour of EY and Mona Mahajan of Edward Jones from New York City. This is Bloomberg. So some pushback from Andrew Honhorst of Citi. You might expect that. He just published. Risks are skewed dovish, Lisa, as markets are running with a no-landing narrative despite the last 2 weeks of data showing both job growth and core inflation are slowing. He is not in the Matt Lazzetti of Deutsche Bank camp. Matt Lazzetti, of course, is expecting a rate cut this week, and then the Fed's going to be on pause for the whole of 2025. Andrew's pushing back against those views.
I would push that further and say that pretty much all of the guests on Team Surveillance this morning have basically been talking about that same type of dovish surprise, whether it's Steve Chiavarone, we heard from Kelsey Berro over at JPMorgan, all of them talking about how maybe this market has taken it too far, that we're not going to get the disinflation that we'd expected 2 weeks ago. I wouldn't be surprised. I mean, we could just come up with another narrative in 2 weeks, and then another one 2 weeks after that.
Tomorrow after retail sales.
Let's do that.
Who knows? The bond market starting the week rallying just a little bit. We're down 3 basis points on a 10-year, 4.36. On a 2-year, we're down 2 to about 4.22. In the equity market, here's a snapshot of things for you. Equity futures on the S&P 500 pushing higher by a few tenths of 1%. We're up a third. We're at 0.6 now on the Nasdaq 100 following 4 weeks of gains. for mega cap tech in America. 1 hour away from the opening bout. Let's get you some morning movers. Let's check in with Manus Cranny. Hey, Manus.
Jonathan, we've got Honeywell on the board, bid this morning up by 2.36%. How do you deliver for your institutional shareholder, your activist institutional shareholder that is a $5 billion holding in you? That is, of course, Elliott. You use brilliant words. Transformational changes, unlocking shareholder value, read shake-up, read divestment potentially of the aerospace business. What is the growth in aerospace? About 7% per annum over the next couple of years. So it is about extracting value from the assets that you have. So it's the classic PR release, but this is about sating the need of the activist investors. This is a company which sliced its sales outlook by $400 million just a few weeks ago, cut the free cash flow by over $500 million. Elliott wants extraction. Ford on the downside, Jeffrey says they're going to face perhaps one of their biggest existential questions: to resize, if not exit, from Europe. The gap widens between warranty provisions and the related cash outflows. So there's pressure in Ford. By the way, you've got the most amount of underperformance AA sells, ACA sells, since 2009. So you're looking at a $9 target from Jeffries on that. Give you the snapshot on Capri. This is all about affordable luxury. Where does it go? How does it get split up? Where does it get sold off to? The two brands are Versace and Jimmy Choo, held within this family, which is Capri. We understand that they have appointed bankers to either sell as one-stop shop or split it up. Of course, that's after the Tapestry deal failed to materialize because of a number of legal reasons just a few months ago. Jonathan.
Manus, thank you. That stock higher by 4.6%. A lot of people have struggled with that story, including myself over the last year or so. What can and what can't get done under the Biden administration, of course, is an exercise that's not worth having now because there won't be one in the next 4 years or so. But ultimately, just reflecting on the last few years, it's been kind of bizarre, hasn't it?
Very heavy when it comes to antitrust policy, which is why you saw a ton of M&A deals fall through. And then a lot of people saying, we're just going to wait on the sidelines. And now you think there's animal spirits in financial markets. There's animal spirits when it comes to potential M&A deals.
We've had this conversation a lot through the years so far. And I keep reflecting on an interview that we did with Brian Moynihan at Bank of America over at their headquarters back in February, March time. And he basically told us that there were a lot of people that wanted to do a deal, but didn't know the kind of deal that could get done would pass scrutiny down in Washington, D.C., and that's why they weren't even coming to the table and closing one or even talking about having one. And I wonder how much that changes in the next few months.
How much that's already changing as people sort of set up for next year. Key question to me will be, who will be the test children who will come out there and really figure out what's allowed in the new administration? It will be different, but there still will be restrictions, particularly around certain types of tech transactions. So that's going to be an interesting trial balloon that's put out there.
Is tech the first place you'd look?
Yeah, I think so. I think, where would you look? Handbags?
Media as well.
Airlines?
Yeah, especially
Think about
after
Spirit.
everything that's gone on.
Would Spirit be filing for bankruptcy if that deal was allowed to go through?
True. And we talked about it at the time. Some of these things just did not make sense at all. And here we are. Looking ahead to the Federal Reserve, as always, it's what we do here. Traders are waiting for the Fed's final decision of the year. That comes on Wednesday. Lydia Boussour of EY writing, given cooling labour market conditions, strong productivity growth and moderating inflation trends, we continue to expect a rate cut of 25 basis points at the December meeting. Lydia joins us now for more. Lydia, welcome to the programme. It's a three-part act, as you know. It's not just the decision, it's also the news conference, but we also get the economic projections in the SEP. And I wonder, when you look across CPI, when you look across growth and unemployment, the changes that you and the team are expecting this Wednesday, what will those changes be?
Good morning. So when we look at the summary of economic projection, we are expecting to see, the dot plot showing 3 rate cuts next year instead of 4, and another 2 rate cuts in 2026. We're also expecting to see an upgrade to GDP growth. We had 2% in the September projection. We're likely to see now 2.4% by year end for GDP. For the unemployment rate, we're likely to see it nudge down to 4.2%. And then, also inflation moving higher, given the latest numbers and the inflation stickiness that we've seen in the recent months. So we're likely to see 2.8% for core PCE, up from 2.6%. So really a reflection of this environment where inflation has been a little stickier and growth has been holding up fairly well.
Lydia, that last point is the important point. It's reactionary. We're marking to market. How much of this is going to be anticipatory, anticipating the changes from Washington, D.C.?
Yeah, I think we have a dot plot that's going to be useful in terms of providing a path and a view of where the interest rate trajectory is heading. But we also have, as we know, a Fed that's extremely data dependent. So part of this is likely to reflect essentially what we've seen in the data, the data that has been coming in essentially.
Meanwhile, we're talking about some of the ways that Wall Street is gearing up for next year, regardless of what the policies are. I mean, we're talking about M&A, and I'm just wondering, as an economist, given that we are expecting a surge in mergers and acquisitions, do we understand the economic impact of that, whether it comes to either efficiencies of scale, whether it goes to increased productivity, whether it means increased layoffs? Do we have a sense of that?
Yes, so I mean, when we look at the economic outlook next year, and what we're seeing in terms of business sentiment, we are expecting to see an upside from a more business-friendly environment and a turn in business sentiment, and we do think that that's going to have a positive impulse on growth, a modest positive impulse on growth. Now, when we look at the broader economic outlook, that's going to be offset by some of the other policies that are going to be put in place when we think about immigration, when we think about trade policy and the potential for tariffs. We're likely to get a drag from these policies, and that's going to create an offset. So when we think about the outlook in 2025, 2026, we do think that, when you look at all these moving parts, we're likely to see GDP growth slightly lower. So we have a modest drag from all of these policies, but there are a lot of moving parts, and some of these impacts are going to be offsetting each other.
What are you looking for, Lydia, on Wednesday when we hear from the Fed, given that they're probably not going to give a whole lot of guidance as to their predictions for 2025? What guidance can they give us?
Yeah, so, I mean, when we think about the policy assumptions, I think Powell is going to be sticking to this idea that we don't guess, we don't speculate, and we don't assume. So this idea that they're not going to be putting any policy assumptions into their forecast. I think when you think about Fed Chair Powell and how he's going to be setting the stage for a pause, which is our base case in January, I think he's going to be relying on this idea that the economy is in a good place. Inflation also has been a little bit stickier. And the fact that the Fed is essentially going to be moving in this dark room full of objects. So this idea that they need to be moving a little more slowly, I think that's the message we're going to be getting from Powell. And that's because also he won't be able to, highlight the inflation risk from all these potential policy shifts that we're going to get from the incoming administration.
Well, putting these two stories together, how much could stickier inflation not just be an annoyance for Jay Powell, but also be difficult for M&A and deal making in 2025 and 2026?
Yeah, I mean, this is a key risk in terms of the inflation upside from higher tariff and from stricter immigration. When we think about the inflationary impulse, and we've done some scenario analysis around some of the proposals, and the latest one, which is the 25% tariff on Canada and Mexico and the 10% tariff on China, and we're looking at an inflationary impulse in 2025 of 0.4 percentage point on inflation. So that's going to be a key risk. And we've also baked in a trajectory for inflation that's going to be modestly higher. Now, as you know, there is a lot of uncertainty surrounding all these policy shifts. And that's also the reason why the Fed doesn't want to make too many policy assumptions, around tariff, but also around immigration as well. It's really a wild card for the economy in the next 2 years.
You've done a lot of work on the M&A activity we could see, and you say it's expected to rise 10% just next year alone. Who's going to be the biggest winner?
Yeah, so we're expecting to see a rebound in activity, and it's really on the back of this, continued positive economic environment. We have less uncertainty as well. If you think about where interest rate is heading, where the Fed is heading, where inflation is heading as well, there is a bit more visibility. And in this post-election environment as well, as we talked about, this more business-friendly environment, there is some potential positive impulse. We also have interest rates gradually move lower. So the outlook, we're positive on the outlook in terms of seeing that rebound in activity in 2025.
Hey, Lydia, appreciate your time. As always, Lydia Boussour there of EY going into the Federal Reserve decision on Wednesday. US retail sales also tomorrow morning. Jim Reed of Deutsche Bank's just published their global market survey for 2025, just put out the results. There's some interesting bits in here about policy in Germany, in the United States, on tariffs, etc. I'm very interested in the comparison between the United States and Europe. So I'll pick out a few points here from their survey. Only 2% believe US growth will be below 1% in 2025, and that's the average expected in Europe. Nobody saw European growth in 2025 above the average expected in the United States, which is absolutely amazing. And they also say this: US long-term inflation expectations are the highest in a year, but in Europe, they're the lowest since Q2 of 2021, which speaks to this very different conversation that we're having regarding the ECB and the Federal Reserve.
This screams of parity. I mean, this screams of basically everyone shorting the euro, because there is nothing in here that leaves anyone at all excited about the idea of anything in Europe, A. And B, has the divergence ever been wider? And that, I think, is a really important note.
But maybe one point which will help Europe is he says the base case that investors think Trump will be a bit less aggressive than his campaign promises on trade. So maybe that's a window and an opening for at least Europe, where it won't be as hard when it comes to tariffs. The issue, of course, Europe is going to have is if they go up on China, China's only going to have one place to really start dumping.
I'd actually say that reinforces the view of why I'd be even more worried about Europe. If these are the numbers they expect for European growth with a less confrontational Donald Trump,
True.
I wonder how much worse the outlook would be otherwise. I also have to say this is a good snapshot of where expectations are. And I'd go back to something that we talked about earlier on this morning, how little needs to go right in Europe to change the story a whole lot more. If you take this note from them, only 2% of German responses think the debt brake will remain completely unchanged. The number is notably higher outside of Germany. Just how big a change could we see in some of these places?
If Germany borrows any more than they already are, if they're basically more amenable to the idea of increasing that deficit in the short term to invest in real projects, how big could the boost be to some of the asset prices, especially when paired with an ECB benchmark rate that's lower? When I talk to people, the most contrarian bet right now, I mean, this is almost consensus at this point, go long China and then go long Europe, because they're going to have the twofold low expectations and a central bank that's going to be easing much more considerably.
Take a snapshot of things right now. Equities just about positive by 1/3% on the S&P. On the Nasdaq 100, up by 0.5 in the bond market. Some real disruption through last week. Yields higher across the curve by double digits on a 2-year, a 10-year and a 30-year. On a 10-year and 30-year piece of the yield curve, we were higher by more than 20 basis points. At least this morning, we're down about 3.
Yeah, last week was the biggest increase that we have seen in the 10-year yield going back to October of 2023, at a time when no one can really give one reason as to why. I mean, basically, it's just the feeling changed. And the feeling was a stickier feeling. And those feelings will get discussed on Wednesday.
Vibe shift
Yes.
is a quote that I've seen in so much research. There's just been a massive vibe shift over the last month. Mahajan of Edward Jones looking ahead to the animal spirits of 2025, writing, investor sentiment is heating up. And as the bar of expectations keeps rising, it leaves potential room for periodic disappointments. Mona joins us now for more. Mona, welcome to the programme. Embrace the bubble was a noteworthy headline over the weekend in Barron's magazine, a magazine I typically enjoy over the weekend. Mona, your view on that? Should we be embracing some areas of the market that have looked frothy, but it's been expensive to bet against it over the year so far?
Yeah, thanks, Sean. You know, look, it does always feel like markets can run to the upside and run to the downside beyond what most investors usually expect. And so in this scenario, we're still looking at a market that is underpinned by solid fundamentals. So we're looking at an economy that is still expected to grow in Q4 by 3.3%, according to the Fed GDP now. We're looking at a Fed that is still moving in the right direction. It's moving rates lower. And by the way, earnings growth is expected to be double digits, perhaps 10 to 15% in 2025. So the underpinnings are in place. The backdrop looks pretty solid. Markets, though, have run quite a bit. We know we're at a 27% clip higher in the S&P 500. Could we have more gains ahead? Perhaps, but we do see more volatility and more bumps along the way as well.
Mona, is the U.S. the only game in town, or is it starting to shift as the expectations have already been borne out in the price in the United States and not so much elsewhere?
Yeah, look, the U.S. exceptionalism story, we think, still has some legs here. And parts of the market do look frothy. Perhaps valuations have been extended, and we know what's going on with mega cap technology and that Magnificent Seven. But the parts of the market that haven't really seen a lot of valuation expansion, you look at the broader S&P equal weight index, still trading around that 17 to 18 times forward multiple, not stretched by historical metrics. You look at part of the value and cyclical parts of the U.S. market, even looking down to the mid-cap sector in the U.S., not stretched historically from a valuation perspective. And so we think there are still opportunities for that U.S. exceptionalism to play out. Keep in mind, those parts of the market are typically more domestically exposed as well. They have more U.S. exposure than, say, the mega cap technology parts of the market as well. So they could continue to perform in our view.
The past 2 weeks have been sort of a little bit of a fly in the ointment to that story, because that really was the story in November, this idea of the broadening out. And then last week, we saw a real outperformance of big tech. And a lot of people said it was simply because yields were higher. How important is it for yields to keep creeping lower, for the disinflation story to remain intact, to keep that thesis in place about a broadening out?
Yeah, you know, look, a contained inflation story is essential to this economic backdrop to continue to play out. If inflation remains in what we think will be kind of a 2 to 3% range next year, the economy can hold up pretty well in that backdrop. We've seen that this year as well. If we start to see inflation move beyond that, which we don't see in a base case getting back to anything in that 3, 4, 5% plus range, that's where we start to hit real kind of roadblocks in the economic growth picture. And we know what underlies kind of cyclical growth, cyclical parts of the market doing well is the economy continuing to do well as well. So we think from a consumer perspective, the important part of this story also is that wage growth continues to exceed inflation. So folks are taking home real wages, which is helping the consumption story. That is all part of how the broadening of market leadership continues to play out. There will be ebbs and flows in that story, but we think generally diversified portfolios will continue to be a winning strategy as we head to the next 12 to 18 months.
Well, Mona, when it comes to ebbs and flows, JPMorgan's head of global market intelligence was talking about the fact that there's potential for a pullback in mid-January around the time of the inauguration. Are you expecting a lot more volatility early on in the Trump administration?
Yeah, you know, look, there's a lot of eyeballs on what the administration will do on some key variables here. What is their tariff policy going to look like? Will they go to the more extreme proposals where it's across the board 10 to 20% and even more so in China? What is the immigration policy going to look like ultimately? Will they have or implement some sort of supply shock to the labor market?
OK, I think that has gone. Diversified, broadening out of the rally. We've heard a lot of that. It's just not working over the last few weeks.
I thought you were going to say diversifying of the broadband, because I have to say
that's diversify part of
that too. We're going to diversify
Cable
that.
providers.
Exactly. Well, we've been hearing a lot of the diversification story. I want to diversify my bandwidth. I was having trouble with it last night too, so I relate.
With your cable,
It
your
has
broadband.
to be because of the drones.
I think so. I think you're right.
Oh, right, yeah. New conspiracy theory.
100%. They just want to disrupt
Like
our
that.
cable.
Hey, you've got a theory that John Kirby doesn't have, because he's not sharing anything right now. Right?
Maybe
no one knows anything.
If you want to join us and talk about your cable connection and how that's a problem, John Kirby, you're welcome to come on
Particularly in the New Jersey area. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Luigi Mangione, the suspect in the killing of United Healthcare CEO Brian Thompson, has retained a high-powered New York attorney and former CNN legal analyst to represent him. Karen Friedman-Agnolfio will represent Mangione as he faces a second-degree murder charge. Mangione remains in jail in Pennsylvania, where he was arrested last week. Manhattan DA Alvin Bragg said that there were indications that Mangione may waive his extradition. Cocoa futures hitting a fresh record high in New York as trading supply concerns grow. The rally increases odds that the already high cost plaguing chocolatiers and consumers will worsen. Weak harvests for the commodity in West Africa have plunged the world into a supply deficit. And LeBron James returned to the LA Lakers last night in a 116-110 victory over the Memphis Grizzlies. James missed 2 games dealing with a left foot injury and was away from the team most of last week because of personal reasons. James had 18 points, 8 rebounds, 8 assists, and 5 turnovers in 34 minutes of play. The Lakers are currently 14-12 on the season. And that's your brief. John.
Danny, thank you. Thanks for this morning. Up next, setting you up for the week ahead, live from New York. This is Bloomberg. The opening bell around 36 minutes away. Equity futures on the S&P up 1/3%. On the Nasdaq up by a little more than that. Your trading diary, the calendar for the week ahead looks like this. S&P Global PMIs coming at 9:45 Eastern Time. Look out for that. Tuesday morning, retail sales. Wednesday, it's the big one. A Fed rate decision at 2 p.m. Eastern Time, followed by Chairman Powell's news conference at 2:30. If you're around on Thursday, you'll get some jobless claims and a rate decision from the BOE and BOJ. If you're still around on Friday, you'll get the core PCE and UMich consumer sentiment. If you're still there in Europe, I don't know when vacation starts over there.
I think it's already started.
You're focused on the politics. German Chancellor Olaf Scholz awaiting a vote of confidence in Parliament, a vote he expects to lose. Ollie Crook has been covering the story all morning for us out of Berlin. Ollie, what's coming up?
Yeah, so listen, John, we've just had the sort of speech from the Chancellor Olaf Scholz speaking before Parliament that really kicked off proceedings today at 1 p.m., really sort of laying out in many ways his positions for this election, really saying what he wants to do with another term were he to be granted it. And he's really talking about spending, really spending a lot in Germany in terms of infrastructure spend, in terms of getting that spending up on defense. And right now where we are in the actual Bundestag right now as we speak, we have the debate, the 2-hour debate that ensues after that. And then after that, there's going to be a sort of line vote of all the lawmakers in the Bundestag. After that, we will get the outcome. We will likely get a no confidence vote on Chancellor Scholz and this government. That will then allow Scholz to go to the president and to sort of dissolve the government and really pave the way for these elections. Germany, the only country probably in the world where you have snap elections and it takes almost 4 months to get them done. And that'll be on February the 23rd when you will get that election.
Ollie, just quickly, when does vacation for Christmas begin in Germany? When does that happen?
Yeah, it's going to be at the end of this week. You can see the Christmas tree behind me, as well as some of the protests that have just been unfurled on the Brandenburg Gate.
There we go. I can just about work out what that says. Ollie, thank you. Ollie Crook out of Berlin. The Christmas markets in Germany, Bramo,
Beautiful.
These things start early. Beautiful.
Yeah.
People fly in for those.
Yeah.
Didn't we hear that from Delta, that they were making more money from those flights?
Yes, that people fly in for the Christmas.
And euro-dollar at 104 is
all
helpful.
I can say, in Switzerland, it starts at 4:30 p.m. on Friday, and everybody immediately goes on vacation.
Some of us are actually working the Christmas week. Just like to throw that out there.
OK. All right, some of us might check out completely at about 3:30 Eastern Time on Wednesday afternoon. I don't know what the show's going to be like Thursday, Friday. I've got no idea. I'll be here.
I think you're going to be here.
Kinda,
So
like
that's gonna be
physically
exciting.
we'll be present, but mentally might be elsewhere.
That's your promo.
All right, that's the promo for tomorrow too. Mark McCormick at TD, Mike Wilson of Morgan Stanley, Dan Greenhouse of Solace Alternative Asset Management, Amanda Lynham of BlackRock. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.